feature on Zoom, and then ask the question when.
And after we call your name.
Answer the question. Ask the question after we call your name.
Oke. Udah, kita lihat nanti yang raisan siapa bla.
Oke.
Yang jawab kita.
Iya, nanti kita tungguin kan.
Okay.
Tinggal lihat grupnya.
Oke. Terus dah.
And now we are going to announce the first team that made it to the grand final. We would like to introduce Mr. Michael. Invite them to visit.
Invite.
We would like to invite Mr. Michael Abrahamcom as the president of the 20th ICMSS to announce the first team that will be presenting the research.
Udah masuk dong. It's getting real. Let's go. Good morning to our distinguished panelists and outstanding delegates. Welcome to the third International Equity Research Conference Day of the 20th ICMSS.
My name is Birtuwaleo Nuru.
And my name is Kiziata Mariska. We are here as today's Master of Ceremony.
First of all, we would like to thank the panelists and the delegates for attending the third day of the 20th ICMSS International Conference.
The third conference day consists of two sessions. The first one is the grand final presentation, in which the top 6 teams will present their equity research presentation in front of the panelists and delegates. The second one is capital market sharing session, in which Mr. Fajar Hidayat, the President Director at Chalendra Capital, who will give you insights on buy side in the capital market. And there will be Mr. Oki Ramadana, the President Director of AHPC, that will give you insights on the sell side in the capital market.
All right, before we start the grand final presentation, we would like to introduce you to our esteemed panelists.
Apologies for the technical difficulties.
Apologies, we have technical difficulties.
So please just wait a moment.
So just please wait for a moment until our technician solves the problem.
Yeah, sure. Okay, moving on. The first panelist we have is Mr. Ari Jahja, the head of equity research at Macquarie Group. He graduated with a Bachelor of Business Administration from Baruch College. His 11-year work experience includes a stint as an equity research analyst at Credit Suisse.
Our second panelist for the grand final is Mr. Andre Nasseri. Currently, he is a director and head of Indonesia research at Credit Suisse, covering Indonesian strategy for autos and industrials. Andre previously was from PT Bahana Securities, where he was the head of research, covering Indonesian strategy, autos, banks, and telecoms.
Our last panelist is Mr. Ricardo Silan, the head of investor relations at Indica Energy. He is a member at the CFA Society Indonesia's board of directors and a judge of the CFA's Global Institute Research Challenge. Mr. Ricardo has 15 years of equity experience and previously held the position as head of institutional equity sales at DBS Vickers Securities. Delegates will get through all the guidelines first, so please save your questions until the end of this briefing. Without further ado, let's get right into the presentation details.
For the presentation methodologies, the top 6 teams with the highest score will present their answer in this session. Each team will be announced right before their turn. The presentation is limited to 10 minutes. The timekeeper will provide 5, 3, and 1-minute warnings. The Q&A session is limited to 15 minutes and is open for panelists only. The teams are allowed to discuss before answering the questions. Each delegate has to make sure to turn on your camera and microphone during the presentation, and after your turn is finished, you may only turn off your microphone.
In deciding which teams will qualify in the grand final round, the total score will be based on the team's equity research report score, weighted 50%, and the team's semifinal presentation score, weighted 50%.
For the presentation scoring criteria, first we have financial analysis, values 25%, then it has valuation worth 25%, presentation worth 20%, question and answer worth 20%, then it comes to team involvement worth 5%, and the last is materials worth 5%.
And the top 3 equity research teams who will receive total prizes of $2,700 plus certificate.
If any of the delegates or panelists have any questions regarding the briefing, please use the raise hand feature on Zoom, and you can start ask the question after we call your name.
So, Berto, are you excited for the grand final?
Yes, I am for sure.
Yeah, me too.
I would like to remind you again, if you have any questions regarding the grand final presentation briefing, please use the raise hand feature on Zoom and start the question after we call your name. If there are no questions, we will continue to the grand final presentation. Now, we are going to announce the first team who made it to the grand final. We would like to invite Mr. Michael Abraham Hukom as the president of the 20th ICMSS to announce the first team that will be presenting their research.
Hello everyone, my name is Michael Abraham Hukom, and I'm currently the president of the 20th ICMSS. I would first like to say good luck to all the delegates that will be presenting today. So, the first team who will be presenting in the grand final of the 20th ICMSS is Lakan. Congratulations Lakan for making it to the grand final. Please prepare your presentation and make sure to turn on your camera as you present your equity research report to the panelists and other delegates. The representative delegate may start screen sharing your presentation window. Good luck.
to decline, going down to 1.76 in the next 5 years. In addition to that, the company's interest coverage ratio shows that AP is more than capable of paying any interest it has on its debts.
Backed by its financial strength and stability, AP is in the position to support its aggressive expansion in the power industry. It had set the goal in 2019 to reach 4,000 megawatts in installed capacity by 2020. And despite the challenges brought by the pandemic, AP did not only reach that goal, but even exceeded it, reaching 4,973 megawatts capacity this year. More than that, AP has also maintained its consistency in paying dividends, issuing 8.60 billion dividends last March 2020. This led us to believe that AP's dividend payout ratio will remain high and intact moving forward. We see shareholders enjoying 14.42% growth year on year in their dividends from 2020 to 2024. In spite of the experience setback in 2020, the Philippine Department of Energy still sees lucrative growth in the energy industry. Based on their projections, energy demand is expected to grow by 5% each year. With this, demand is seen to overtake supply by 2027, and the country needs an additional 43,765 megawatts capacity to meet the demand. On top of the ever-growing electricity needs of the country, Malampaya gas field, the country's main source of liquefied natural gas, is expected to run dry by 2027, thus widening the demand-supply gap. Fortunately, AP is well positioned to meet the gap as they plan to aggressively double their capacity to 9,300 megawatts by 2029 through massive investments in renewable energy power plants. The company also has the goal of having at least 50% renewable energy sources in its energy mix by 2029. AP already started with its goal and currently has 3 hydropower plants in their pipeline. With AP's investments in additional power plants in the next 10 years, AP stands to benefit from the forecasted increased demand as the firm will be able to maximize its generating capacity.
In line with AP's strong historical performance, resiliency amidst the pandemic, and being at the forefront of energy industry growth, we have derived a target price of 35.95 pesos, posing a 32.66% upside. To arrive at this number, we used a discounted cash flow model with an 8.28% WACC and 3% terminal growth rate. Our WACC is based on a 3% risk-free rate, while the terminal growth rate is based on the long-term inflation rate of the Philippines. In terms of free cash flow to equity, we derived a fair value of 34.02 pesos. Valuing AP relative to its peers confirmed our bullish outlook for the company after it gave a fair value of 37.65 pesos. We also performed a sensitivity analysis indicating that even if there was an increase of 50 basis points in our WACC, our buy recommendation would still hold. Amidst our very bullish outlook, we recognize that AP still has inherent business risks. First, delays in plant construction. It takes 2 to 3 years on average for a power plant to be completed. Any major delay would increase construction costs. This is why the company regularly checks the progress of their plants and coordinates with the National Grid Corporation of the Philippines, or NGCP, in advance to ensure that its plants will be connected to the grid immediately once completed. The next risk would be the heavy regulation in the power industry business. Failure to comply with the government's rules and regulations would result in hefty fines like what happened to their peer, Meralco. ERC also dictates the rate which distribution utilities charge per kilowatt hour. Fortunately, for AP, this rate has to decrease by 50% for us to give a sell rating. The company also has a legal team that ensures every single AP subsidiary complies with all the rules set out by the government. Lastly, natural calamities or even just unfavorable weather can either stop or make operations inefficient. The company's goal of having a balanced portfolio makes their generation of electricity consistent regardless of any weather conditions.
Against all odds, AP has managed to meet expectations and looks to exceed them in the coming year. With strong historical performance, a show of grit through favorable results in the midst of COVID-19, and a promising future in ushering in a new era for the Philippine power industry, we believe that Aboitiz Power is indeed a worthwhile investment. With our valuation of of 35 pesos and 95 centavos, offering a one-year upside of over 32%. We strongly issue a buy rating for Aboitiz Power. Thank you very much for listening, and we are now ready to take your questions.
Hi, I guess it's the time for us to ask the questions. I can start first. Hey, my name is Andre from Credit Suisse. Thanks for the presentation. Luzon team, very energetic. Like the whole flow of the presentation. Just wondering, you have not talked a lot about your the spiking up input prices, and I'm not sure what they're using. I'm assuming it's predominantly coal. That's one. Second, it's you talk a bit about the tariff, right? So do you think there'll be more pressure on that front, and that will result in a lack of upside in the future?
Okay. Thank you very much, sir, for your question. First, Mr. Ice, can you please show the slide showing the rise in coal prices? So yeah, so as you can see in this graph, coal prices are steadily increasing. And if we go to the slide showing AP's generation mix, yeah, as you can see here, 74% of their generated capacity is coming from coal. So you are indeed correct, sir, that the company is in risk of rising coal prices. However, the company said to mitigate this risk that they are engaging in commodity swap contracts to hedge themselves from the risk of increasing coal prices. And furthermore, moving forward, they have this plan. It's called Cleanergy plan, wherein for up to 2029, they will have 50% mix of renewable and non-renewable energy sources. Now, if we go to the calculation on how we calculated our revenues from generation, Mr. Ice, can you please show the judges the 10-year Westm Prices? So 96% of Aboitiz Power's generation is actually contracted. And we have no information with regards to the contracts on how much they charge. So which is why we use the average Westm prices of 5.09. This is the prices. This is the price that we used in our forecast. Now, moving forward, there's a tariff. There's a feed-in tariff if they're going to renewable. Mr. Ice, can you please show the judges the feed-in tariff? So moving forward, since the company plans on generating renewable moving forward, the 5 pesos that we used for calculating generation is actually very conservative, because if they move forward and start building renewable power plants, as you can see, all of these renewable sources of power plants, they are allowed to sell it at these prices. And according to the the Green Energy program of the DOE, distribution utilities are required to buy AP's renewable power plants in the near future.
If I may add to my groupmate Von's answer, another advantage that AP has in this regard is its new research and technology in partnership with an international energy company as well, wherein they have been able to develop floating solar islands. Currently, they have a lot of hydropower plants, and being able to repurpose those hydropower plants to also be able to produce solar power plants, solar energy through their floating solar energy farms, it can also make sure that there's a less capital investment needed for even more power generation through their hydropower plants.
Got it. Thank you. So basically what you're saying is that with more investment in renewables, the risk on input price will lessen. Is that right?
Yes.
Got it. Sure.
Thank you.
I'll let the other panelists ask questions.
Hi. My name is Ricardo. I would like to ask, could you tell me um, who are the main clients and how's the tariff is set up and how flexible is this tariff to be adjusted?
Okay. So for their clients are mostly distribution utilities like Meralco, and they also own distribution utilities. And how this is set up, Mr. Ice, can you please show the judges the part where about the risk of regulation? Okay. Now, as you can see here, it's the ERC that dictates the rate wherein distribution utilities charge per kilowatt hour. Now, this should this rate decrease by 50%, it has to decrease by 50% for us to give a sell rating. And when we talk about the generation part of Aboitiz Power, 96% of their capacity is actually contracted. And moving forward, there's actually a law, EPIRA, stating that any company cannot build or construct a power plant unless 85% of their power plant will be contracted already. So the moment that power plants are constructed in the future, AP is ensured that there will already be a buyer for that. And given the fact that there will be a forecasted supply-demand gap, we believe that AP will be able to maximize its generating capacity.
The final tariff borne by consumers, household, are they regulated by the government? And how often is the government adjusted that tariff?
Okay. Thank you very much, sir, for that question. So, in EPIRA states that there is this thing called a regulatory period. The government adjusts it every 4 years. Currently, Aboitiz Power's regulatory period has expired as of 2019, and as of now there is a new regulatory period. So it will not be adjusted in the next 4 years. And we have found out that the adjusted rate per kilowatt hour that is dictated by ERC is actually around this 1.78 that you guys can see in the slide.
Could you educate me why the cash flow dropped from 2019 to 2020?
Okay, thank you very much for that question. So, Mr. Ice, can you please show our statement of cash flows? So, mostly the reason why there is a drop of cash flows is, if you guys can see, from 2019, our net cash flows from operating activities was around 39 billion pesos, and it dropped to 25 billion, around 25 billion pesos. This is because of the COVID-19 pandemic, and there's fewer demand for electricity.
Aside from that, their costs increased to some extent because their cost of purchase power increased due to the fact that they had some power plant shutdowns, and in order to fulfill the contracts they had with some of their clients, they had to buy power, which was at an increased price on the Westm, which is the spot market. And because prices were because they were buying more electricity from the Westm, this also increased the prices there. So it also increased the amount they had to put out in order to get the same amount of electricity out of the spot market. However, moving forward, with more of their investment into renewable energy power plants, which are said to be more stable and less prone to shutdowns, this problem is seen to be decreased. That's why we foresee that their cash flows will indeed increase, because moving forward, COVID-19 should be able to calm down with the vaccine rollouts that the Philippine government is implementing, and also with their diversification in their renewable energy portfolio.
Well, it's interesting to note that even though that you are expecting better economic activities in 2020 after the vaccine, your forecast saying actually this will be worse in terms of cash flow. Why is that?
Sorry, can you please repeat?
Your forecast, the cash flow actually will be worse this year compared to last year. Mostly because of the financing. Why is that?
Yes. The reason why it will be worse because of the financing is because we believe that right now, since interest rates are very low, AP will be taking advantage of that, and they have said that they actually took a loan around 800 million pesos, and since this is just a short-term loan, we believe that they will have to pay it in the year after, which is why we expect cash to be worse when it comes to 2021 because they will be paying back the loan that they took for 2020.
Okay, then I let the other judge to ask.
Okay, thank you. So good morning, everyone. I'm Ari from Macquarie. Nice presentation and then thorough analysis on its historical performance. So I have a couple of questions here. So first, just wanted to get a better understanding right behind the top line growth assumptions. So it seems like you're forecasting the 2021 revenue to return to the 2019 level. So on the volume side, how do you estimate the electricity consumption growth going forward? And then is it typically correlated with the Philippines GDP, for example? So I'll start here. Thanks.
Thank you very much for that question. So actually, electricity demand is actually strongly correlated with the GDP. However, Mr. Ice, can you please show the part where the GDP of where the distribution utilities? Okay, so historically, the GDP of Central Visayas and the Davao region, where the distribution utilities of Aboitiz Power is located, historically they have higher growth compared to that of the entire country. Actually, in 2019, the growth in Visayas and Mindanao, the peak demand is twice of that of Luzon. That is why we believe that moving forward, since AP's distribution utilities are located in strategic areas of growth, we believe that they will have higher revenues because of that.
I see. So, okay. And then secondly, right, on the Capex, can you elaborate on their plans? Since it seems like there could be rising investments towards renewables as part of the energy mix. So just want to get a better understanding on that as well. Thank you.
Okay. Thank you for that question. Mr. Ice, can you please show the generation mix of AP right now? Okay, so I just want to show this. If you look at the right pie graph, this is the energy mix of AP right now. So as of the moment, it has 3,600 megawatts, and that is generated through coal, and oil is around 200. So if we add those two together, it's already 3,800 megawatts of non-renewable sources. Now, AP stated that it has already a power plant under construction that's expected to finish in 2021 or 2022. Now, assuming that it will be finished, it will have another 600 megawatts to AP. So, given that, it will have a total of non-renewable source of around 4,400. Since their goal in the future is 50-50, so most of their power plants will already be made using renewable. Now, as for the Capex, we actually, when we did Capex of 23 billion, the budget that we gave for that, how we got it was we took into account what are the possible renewable energy power plants that AP might build in the future. And then we took the average construction cost per megawatt. And we found out that AP needs at least 585 megawatts to be able to achieve their goal. And the 23 billion Capex budget that we gave for AP is actually sufficient to be able to generate that 585 megawatts year on year that they need.
Okay. But in terms of seems like there are quite a few megawatts that's going to come on stream. Do you think that there could be some oversupply risk here, right? That might basically have an impact on tariffs, or that's basically not related because there's sort of payments that the governments are basically guaranteeing to them. So how does it work? Thanks.
Okay. Thank you very much for that. Actually, when we did our forecast, we already took into account, we already valued in the fact that there is an oversupply right now. And even if there was an oversupply right now, that oversupply will actually not matter in the near future because Mr. Ice, can you please show the slide of the energy demand gap? Okay, so as you guys can see here, in the near future, around we predict that in 2027, the Malampaya gas field will already be depleted by that time, and its effect will be felt starting 2022. Now, the Malampaya gas field, to give you guys an idea how important the Malampaya gas field is, the Malampaya gas field is actually responsible for 30% of the generation of Luzon. And Luzon, this is the biggest island in the Philippines. The demand in Luzon is 70% that of the entire Philippines. This means that the Malampaya gas field is actually supplying 21% of the entire demand of the Philippines. And since this is expected to deplete moving forward, we expect that demand will soon catch up with the oversupply. And furthermore, the fact that AP is already moving forward, AP is going renewable. And as you have already seen from the slide where the tariffs are located, the tariffs are the price where you can charge if you're a generation company when you're generating using renewable sources of energy is greater than the average price stated in the Westm.
If I may add to my colleague's answer, the government has been shown to be very, very supportive of renewable energy generation. It has multiple programs which support renewable energy generation, one of which is the feed-in tariffs, which they've promised to remain constant for quite some time until the country reaches its goal capacity for renewable energy, which isn't happening for quite a long time. Even with like AP's full 9,000 megawatt capacity by 2029, that alone won't be able to supply the rest of the country's goals. So there'll still be a lot of demand for renewable energy. Aside from that, even among consumers, they're able to consume more renewable energy through an initiative also made by the government, wherein consumers can have their distribution unit, can choose to get their energy, get their electricity from renewable energy generation power plants. So that can also further increase demand as consciousness for renewable energy generation consumption increases as well.
I would also like to what my colleagues have said. So basically, the target of the Philippines by 2030, the target of our country is that in our generation mix, there should be at least 35% renewable energy. So in line with this, the government has actually promulgated what they call the Renewable Portfolio Standard. So what is this Renewable Portfolio Standard? So Renewable Portfolio Standards mandates that all electric industry participants must source a portion of their electricity from renewable energy power plants. So basically what the government is doing here is that they are ensuring demand for renewable energy developers. So for the transition period was actually last year. So the minimum requirement for the electric industry participants, the distribution utilities, the electric cooperatives, and other participants were actually computed with the National Renewable Energy Board. So to reach the 35% by 2030, the government is actually requiring all these participants to increase their annual incremental minimum percentage of renewable energy energy source from renewable power plants to increase by at least 1%. So basically, we can see that the government is ensuring demand for the renewable energy developers.
And if I may add some final words, Ice, can you please go to the renewable energy, to the generation mix of AP? Okay. Now looking at it here, you can see that renewable energy still makes a small portion of their overall portfolio. But in terms of like the entire country, they actually have the largest renewable energy portfolio already, meaning that they're already fully taking advantage. They're already the firm that's taking most advantage of all of these benefits for renewable energy generation right now. And with our forecasted megawatt additions in the coming years, they're also looking to remain the largest renewable energy generator, as well as the largest generator of energy in the Philippines. So while there's still a lot of room for growth, they're still looking to maintain their dominant position in our power industry.
Got it. Last question, if I may. So basically, you're saying that the Malampaya gas field is depleting in 2022, right? So I wonder about the cost of gas of that compared to the cost of renewables. Which one is actually lower? Thanks.
Okay. Thank you for that question, sir. So as of now, the cost of natural gas, actually generation of natural gas is cheaper compared to other renewables. However, given the fact that Malampaya is expected to deplete rather, starting 2022. This means that companies that are generating through natural gas will have to import them. The reason why it's cheap because Malampaya gas field, Philippines is self-sustaining when it comes to generation of using natural gas. So when it's depleted, the other companies that use natural gas will have no choice but to import it, giving them worse margins. And Mr. Ice, can you please show the gross margins? Okay, so this is the historical gross margins. As you can see, even though AP is not generating using natural gas, it already has high gross margins compared to its competitors. And the fact that the Malampaya gas field will be depleting has no impact on AP since they don't have any natural gas power plants.
Okay, thank you, Lakan, for the presentation.
Got it. Thank you.
Okay, thank you, Lakan, for the presentation. I would like to
Due to the limited time that we have, this is all for the Q&A session. Thank you very much for Team Lapan.
Hey, the voice from the main broadcast is a bit soft, I think.
Is it finished or they have time to ask?
No, I think the committee is trying to move to the next presentation, I believe, but I think they are stuck. But Team Lakan, thank you so much for the time that you spent in explaining to us. Appreciate it.
Thank you very much.
Thank you very much.
Thank you very much as well.
Thank you, guys.
And thank you also for the panel for your very riveting discussion with our analysis.
I would like to say thank you again from Team Lakan's presentation.
Now we're moving on to the second team.
Okay, now we're going to announce the second team that made it to the grand final. We would like to invite Ms. Farhana Birawanto as the Vice President of the 20th ICMSS to announce the second team that will be presenting their research.
Hello everyone. The second team who will be presenting in the grand final of the 20th ICMSS is Apex Frontier. Congratulations, Apex Frontier, for making it to the grand final. Please prepare a presentation and make sure to turn on your camera as you present the equity research report to all of the panelists and other delegates. The representative delegates may start screen sharing your presentation window. Thank you.
I would like to remind you that the presentation is limited to 10 minutes. Delegates, you may begin your presentation now. delay ya?
Okay. Good morning, honorable judges. My name is Jejit. I am here with my colleagues, Jordan and Branson, as APIC Frontier to talk about Rapid Medical Group. So as a summary, we have come to you with a sale recommendation for RMG with up to 25.7% downside potential based on the three key issues. And to go over our rationales, we will talk about IMG business overview, influential factor, valuation methodology, financial analysis, and investment risk in this order. So let's begin with the overview. IMG operation can be divided into three divisions. Its major revenue comes from historical hospital service, where it operates in 8 countries across Southeast Asia. As for healthcare service, this division generates the revenue from more than 100 general clinics around Southeast Asia. The rest of the revenues come from investment holdings, which provide lease incomes. IMG main strategy include economy of scales, hub and spoke model using mobile application as an enabler, and premium service to target customer with high purchasing power. So based on this, IMG's main operation performance is driven by the number of medical tourists that is contribute up to more than 1/3 of the hospital patients, insurance take-up rate, which is the key payment, and then the cost of medical professionals, that is more than 50% of the revenue, and all of which will be discussed as influential factors. So let's first talk about the operating revenue. So despite the healthcare service demand around the world that comes with the pandemic, IMG is likely going to experience a decline number of customers as international customers faced with travel restriction and more compelling competitor in neighboring countries. Moreover, less and less people have such insurance that could cover IMG price as insurance premium around the world consistently grow faster than average earning. And this is one of our main consideration for the top line growth. So IMG operation cost is also expected to increase from increase in staff costs. This is mainly driven by the scarcity of supply of physicians and their rising preference to work for public healthcare service. This mainly affect our assumption on fixed cost growth rate, which ended up being higher than revenue growth. And with further investigation, ING idealistic China expansion is also facing a lot of problems. This expansion also will expose IMG to a competition with powerful established healthcare brand that may be more well-known with better brand presence. Moreover, government policy is also disadvantaging as IMG capacity is limited and Chinese public healthcare system services developing rapidly with heavy investment from government each year. Although IMG has its own mobile application to accommodate the increasing prominence of mHealth application, its competitors is already providing the same service with more feature with a bigger development team, all which leads to a question on IMG projected growth story that creates such a high consensus price, but may not be able to achieve it considering its capability. So looking at the domestic market, the situation is also unfavorable as public healthcare system is becoming more and more comparable in terms of quality and being offered at lower price. This is due to Singapore government
goal to serve the incoming aging population, which would also determine the majority of healthcare industry income. With this information, IMG as a private healthcare player may find harder and harder to attract this group of domestic customers, as most of them, more than 90% of elders prefer public healthcare service. This is another main consideration that explains the slow top-line growth that we use. And now my colleague Jordan will talk more about the valuation.
Thank you very much. Moving into greater granularity. Thank you very much. Moving into more greater granularity into our financial models, I'd like to start off with the WACC. With the WACC, we can see that the WACC, we estimate it to be 6.26%. Based on the capital structure. And although it's cheaper comparable to its peers, we find that Raffles Medical Group can actually lower its weighted average cost of capital by using more debt financing. This is on the basis of its strong financials and also its negative CCC, which will be shared on in later slides. Modeling the investment thesis into our model, we actually first look at the hospital services, where we dissect them and group them into revenue per age segment, because the revenue per age segment would give us a better visual on how the individual clusters get their frequency of hospitalization. Then we move on to the adjusted for its market share, or RMG's medical market share. And the market share for RMG in Singapore is based off of the 2019 revenue split among Singapore healthcare players, while in China it's based on bed count, which will reflect the IPAO bidding policy more clearly. Moving on to medical tourism for financial year 2020 is expected to represent only the first 3 months due to international border lockdowns post Q1. Now, if we look at the domestic clinics on the for Raffles Medical, we expect it to grow at a 10-year CAGR, at the inverse of the 10-year CAGR for the general practitioner clinics in Singapore. This is to model the dilution effects as more clinic grows. The unexciting 1.3% seeks to reflect the increasingly competitive environment and also the strong public healthcare developments that Raffles Medical is facing against. It is an uphill battle indeed. Next, we actually forecast cost drivers, the main cost driver to be staff costs, and this will actually be growing at the Singapore medical tuition fees of 390 bips year on year. Stress testing all our 3 cases also show that the majority shows an overvaluation in this current trading price. Now, we like to share more about the best and the worst case. They both actually mirror the base case scenario, both positively and negatively. So in the best case, it's actually modeled to have a 50% recovery in medical tourism. This 50%, we find comfort in this 50% is because it helps us to model the recovery from past medical tourist patients of Raffles Medical to actually find comfort in the domestic healthcare providers, especially since Singapore especially our neighboring medical hubs are developing more, investing more into medical technology. And next, we actually layer our discounted cash flow with our relative valuation. We see that utilizing the forward estimated forward price earnings of 36.3 times and the EV/EBITDA of 18.26 times. This is actually more. Raffles Medical is actually more expensive than its peers. And if you are to drop your focus down to the peer chart, we actually see that the forward EV/EBITDA and the forward PE ratio charts is actually on a downward trajectory. This shows that the street's forecast is overly optimistic and the growth prospects led to utter disappointment. Finally, we layer with the DDM because of RMG's high dividend yield to peers spread of 88 bips, and we see that the DCF and the DDM actually reflects the squeeze in margins. Now we use a proprietary blend and we reach a target price of 62.4 cents, bringing you a downside profit potential of 25.7%. Next, my teammate will tell you more about its financials. Thank you.
Thank you, Jordan. So supporting our sell recommendations are the weakening financials of Raffles Medical Group. Historical top-line growth rates have been rather unexciting. We expect this profile to continue going forward, primarily due to the weak core business growth slowing as compared to overall revenue 10-year CAGR. This is supported by the increasingly competitive landscape present in both hospitals and clinic segments. Moreover, with salaries and inventories putting a shackle on margins, we expect EBITDA margins to trim by 600 bips to 14.67% going forward. Historically, this is already apparent despite RMG's average revenue growth rate of 2.12%. is dampened by salaries and operating costs, causing EBITDA to decrease at a rate of 1.64%. The chart on the right depicts this OPEX growth rate trend, which will anchor EBITDA margins going forward. Muted top-line growth coupled with oppressed margins supports our sell recommendation. On the balance sheet front, IMG has sufficient cash management with projected current and cash ratios to rise steadily following a financial year 15 to 19 trends. We also see IMG to have good relationship among its creditors from the negative cash conversion cycle. However, with depreciation figures in the newly developed Chinese hospitals and income taxes forming a majority of CFO, IMG's management have a greater control over the visuals of the cash flow. Examining the IMG's capital structure depicts its conservative management, which we expect to stay, and this will prevent IMG from capitalizing on the low interest rate environment. The chart on the right summarizes various financial metrics of IMG, with IMG falling within the interquartile range of most metrics. So they are quite average and not superior, and this does not warrant the high PE ratio IMG is trading at. Moving on to several risk factors supporting our recommendation, we see China's accommodative policies to welcome foreigners potentially boosting their hospital occupancy rate, and also furthermore, IMG's potential to monopolize as a vaccination centers in Singapore can help strengthen its sales revenue. However, this is not likely because the government will want to accelerate the vaccination plan as fast as possible and contract with all the clinics. Lastly, better than expected financial performance from Chinese hospitals could improve IMG's share price with bullish sentiments. To end off, we examine IMG's consistent underperformance in the GTI. We recommend IMG to be transparent with the operation metrics, provide stakeholders more clarities, and lastly, can improve their board by having a more independent mix. Thank you, and this is the end of our presentation. We have a sell call. Yep.
Delegates for finishing the presentation in time.
That will be the end for Apex Frontiers presentation. Now, let us begin the Q&A session, which is limited to 10 minutes and is open for panelists only. Delegates are allowed to discuss before answering the question. Panelists, you can start asking the delegates from now.
Hi, Epic Partners team. This is Ari from Macquarie. Thank you for the presentation. So I like the clear-cut thesis here. Agree that the Raffles Group has too much cash. So my first question is regarding the ramp-up of its Chongqing hospital, right? And then plan to launch in Eastern Shanghai. Just want to get a sense of how the progress there due to COVID. And then when I used to cover the company, Dr. Liu is targeting EBITDA break-even for 3 years in China. So I just wanted to get a sense of what's going on there. That's my first question. Thank you.
Thank you very much for the question. Thank you very much for the question. We see that the Shanghai hospital has actually been ramping up its expansions, and they started the project in 2018. So it's expected previously, to our knowledge, it was expected to complete its constructions by the end of this year. It's supposed to be started launch this year. However, recent news updates are expected to be delayed to 2022. And expect there to be some delays by a few months, and break even is expected to be in 2 years' time, which is 2022. However, one of the reasons why we see that this expansion into China is nothing shy of interesting is because the competition domestically in China is seriously competitive. First, we see that they do not have a domestic or a local taste in their medical services. They are just going cut and paste their business model in Singapore over into China. Moreover, with the e-power policy, it actually limits their bed that is available for service to 20% at the full price. So 20% of the 400 beds would be all for discounted medical. And lastly, if you look at MTech growth is super. And who is actually leading the MTech growth is big players like Alibaba and Tencent, who already have the technological capabilities and also the logistical capabilities. Hence, if China is to actually, if RMG is actually compete in China, it is at a very poor end. Thank you.
Got it. My second question is on Singapore, right? Certainly still the main cash flow driver here. So just thinking about the post-COVID recovery, right? How do you see the kind of the local patients proportion or versus foreign at this point? Because of the competitive dynamics, certainly with the, for example, Glen Eagles Mount Elizabeth, right? So do you think that there could be a lot of growth in Singapore heading into the second half 2021? Thanks.
Thank you for the question. Thank you for the question. So besides competing with the local private players, we also see strong competition coming from the public hospital, and if I may draw your attention to this slide, we can see that local healthcare expenditure has been rising over the years, and we see that the government is actually spending more money to provide healthcare support to the public, and we can see this already being reflected in the proportion of locals that prefer to visit public healthcare. And we also see that with the RMG's lack of sorry, in fact, this slide. Oh, they don't have the insurance partner. My apologies. So with Raffles Medical's also lack of established insurance partners in Singapore, with bigger players such as Great Eastern, AIA, Prudential, we can also see that more of the customers will eventually flock over to the public health end, also coupled with the rising insurance costs over the years. So domestically, we expect growth to be fairly muted because of firstly, a stronger public healthcare system, and secondly, rising insurance premiums over the years, which would, especially with RMG not having partnership with established local players, it will mute local domestic growth rate.
Also, if I may add on to my partner's point, is in terms of medical tourism. Medical tourism represents close to 35% of Raffles Medical's domestic Singapore top line revenue. And with the development of our neighboring medical hubs, such as Thailand, with more than three times of the JC accredited healthcare centers, and also Singapore not actually giving them a very good medical cost discount compared to countries like Thailand, India, or Malaysia, we find that the past medical tourist patients of Raffles Medical to actually be finding comfort after 1 year worth of lockdown with their own local medical providers, especially since the development is at that level of an international standard. Thank you.
Thanks, everyone. I'll have the other panelists follow up. Thank you.
Hi, this is Ricardo from Indica. I would like to ask you, what is the impact of COVID to the medical industry in Singapore as well as for this company in terms of operational and financials?
Thank you for the question. In terms of the impact of COVID, one of the major impacts for Raffles Medical domestically is the border lockups. Simply say that the border lockups has actually taken a third of their margins post Q1. And also, if we talk about their recent financials, their 2020 first half results shows that earnings per share actually dropped by 41.6%. And we expect the full year earnings per share to actually follow that similar downward trajectory to drop to 1.15 Singapore cents. And this is on the financial side. This is where it actually took a hit. Moreover, local management has released during their first half financial report that they didn't see any recovery coming from any footfall coming from the domestic clinics and also the domestic. Thank you.
Any sign of recovery post the vaccinations, post COVID?
Based on our due diligence, we do not see any signs of recovery coming from Raffles Medical. Although, yes, just yesterday, its stock price recovered back to pre-COVID levels. However, where we see is that even before the COVID shock, the only major growth stories are the similar growth stories that they have been saying. Throughout the whole of this COVID period, there has been no updates or developments by the management in Raffles Medical.
Also to add on, we can see that because of COVID-19 travel restrictions, we see that we project many consumers over in the medical tourism side to actually have some changes in their consumption patterns, and we may
and coupled with the growth of domestic medical hubs and facilities in the competing neighboring countries, we see that actually consumers on the end may be more inclined to use their own domestic medical services that are much more better and improved than before. So overall, on our end, because of COVID, we see that there'll be less travel, and even after COVID, vaccinations are more or less completed over at the regional end, we may not see a recovery in terms of medical tourism for Raffles Medical Group because of the stronger domestic medical services on their foreign countries, and also because of a change in consumer patterns. Thank you.
Okay, thank you. I'm good.
Hey, Apex team, this is Andre from Credit Suisse. Just thank you for drilling deep into the financials. Really appreciate that. I guess I'm just trying to I have one question on. I'm just trying to tally that you put the valuation band, they're probably at the bottom end, right? Even though they did have recovered to pre-COVID levels versus the upside risk that you mentioned earlier, and you did cover that a bit. Which is vaccination ramp up in Shanghai. I think you have a good slide on that. So I'm just trying to tally that some of these risks are probably at least halfway likely to happen, right? Maybe if vaccine were to roll, even not this year, but let's say picked up second half and for next year, 2022 onward, right? And they do benefit from all of these risks that you mentioned. Are we perhaps at the bottom end of the valuation? Just want to know your thoughts on that.
Thank you very much for the question. Yes, we see that this risk, with majority of them having a mid to low impact in terms of the upside for Raffles Medical. But one thing that we saw, we took confidence in our sell call that this risk would not actually propagate for the upside is because of the fact that there wasn't any much development and any growth stories coming in from Raffles Medical. And if you look at the vaccination in China, even though if they were to recover, we're not trying to say that China is going to be their next growth story, because that has been something of a 3-year history, about 2 to 3 year history. And if you look at their market share, Chongqing has only 0.58% of the market share in the Chongqing hospitals. And if the Shanghai hospital was to go fully, their market share will only be less than 25 basis points. Therefore, we see that majority of the big brands, global brands such as Ramsay Health, IHG, that actually entered into the Asian Dragon, has actually not did so well. One example is the group CEO of Ramsay Sime Darby, the joint venture, Mr. Bronkumin. He actually said that they left China 5 years ago, due to regulatory issues, and which hit them, and they are slowly recovering from that hit. So we foresee that even though yes, China will recover, the upside and the growth story does not seek confidence in us giving a buy call. Give us 6 more confidence in us giving this sell call.
And to add on to that, we think that the expectation for Raffles Medical Group right now is really high due to the publicized story that they have sold. And even with all these risks becoming true, we see that is really likely that their performance is still not going to be able to meet the high expectation that they currently have on their earnings and the profitability from these projects from China and the vaccine.
Thank you very much, Gino, for pointing out about expectations. Judges, let me show you something about expectations. On the charts below, we see the forward EV/EBITDA and the forward price to earnings historical trend for the past 5 years. And what do we see in common within this? We actually see a downward trajectory. And what does this downward trajectory mean? It means that the EV/EBITDA, the forward expected EV/EBITDA, is growing at a faster rate compared to the market price or the enterprise value. So why we see confidence in our sell call is because of the market's expansion and overconfidence in this growth story, but has been disappointing.
So let me just get back to that. So point number one, well taken. So what you're saying is that management historically has disappointed. So it is hard for us to get confidence. Your second point is that there are some expectations already built up, but based on your valuation band, it seems it's at the low end. So that's one thing, right? Second is if we look at the regional comms, which you have nicely put in your report, they also seems to be at the bottom of the healthcare comms. So is this really a large expectation built in, or is just a slight recovery expectation? I don't know. What do you think?
Thank you, guys. Can you give us some time to think on this question, to discuss this question? Thank you, judges, for the question and the time to discuss. As you can see, that because of all Raffles Medical Group is currently trading at a lower band, it may be due to the fact that actually because of the consistent disappointment by management and investors' expectations being shrink and less optimistic.
Due to the limited time that we have, this is all for the Q&A session. Thank you very much for.
Thank you, Apex, for the presentation. I would like to remind for those who are not presenting, please ensure that your microphone is muted and your camera remains on.
Now, we're going to announce the third team that made it to the grand final. We would like to invite Mr. Ike Alcori as the Vice President of the 20th ICMSS to announce the third team that will be presenting the research.
The third team who will be presenting to the grand final of the 20th ICMSS is Flowsum. Congratulations, Flowsum, for entering the grand final of the 20th ICMSS. Please prepare your presentation and make sure to turn on your camera and microphone. Once again, Flowsum, the time is yours.
Flowsum, we would like to remind you that the presentation is limited to 10 minutes. And the presentation time starts now.
Good morning, everyone. Environmental and climate changes.
We can restart the share screen, please.
Sorry.
It's not showing.
Thank you for that. Sorry, just checking. Can you see the screen now?
Yes.
All right. Okay, let me restart. Environmental and climate changes. Traffic causes pollution. Manufacture and industrial causes pollution, both in air and aqua ecosystem. Global warming, ice melting in Arctic, all happening on our planet. Now, these occurrences drive people to have an eco-friendly lifestyle, and one of which is implemented in EV vehicle. EV innovation quakes the world and create a huge tide of change. But there's this one company is ready and willing to take on the tide. Ladies and gentlemen, we are from Flowsum, and we invite you to come along with Petrified Indonesia in its adventure to ride on the EV wave.
Petrified Indonesia is a nickel mining company established on 1968 and then its IPO in 1990. With ownership structure now consists of VCL, public, SMM, and government through Mine ID. Inco's source of income came from nickel ingot sales, which is made of 70% nickel that carried out based on long-term must-buy contract, using on nickel LME price with 80% sales to VCL and 20% to SMM. Therefore, nickel LME price increase will benefit Inco sales too. When we are talking about the industry, stainless steel is still the main key driver for now, and battery in the future. Based on the left chart, stainless steel has a massive 70% share of nickel consumption, with China still the biggest fish in this industry of stainless steel in production with 59% of world share. In the short term, China's quick recovery will help nickel demand from stainless steel, but in the future, we might see lower growth from stainless steel as nickel consumption for a battery is rising up. When we are looking at the current dynamic, we initiate a buy recommendation on Inco with target price of 5,000 rupiah per share, representing an upside potential 17.1%, with three main catalysts there are lightning fast EV adoption, expected further drop in nickel ore supply, and prospective strategic expansion. Let's dive deeper into these catalysts. The first catalyst we are going to take a closer look at is EV adoption. As demand of EV battery is rising up with EV adoption, nickel will come along as it is the main part for EV battery. Right now, there are whopping 1.2 billion vehicle fleet in the world, but EV share is very small with only lower than 3% shares. However, EV share is expected to grow by around tenfold in the next 10 years. This goes along with EV sales, which is expected to grow with whopping 15-fold until 2030. These numbers show massive growth potential for the EV market. But how does this translate to the nickel market? When we look at the current situation, battery consumes only 6.5% nickel consumption. Riding the growth of EV, battery will multiply its nickel demand by 8 times in 2030. This robust nickel demand from battery will establish strong battery contribution from only 4% in 2017 to 25% in 2030, while stainless steel contribution will slowing down. With Inco huge reserve around 108 million tons, make sure they won't miss out on this opportunity. Based on 2019's production, this reserve will last for another 25 years. Therefore, Inco will have no concern over its reserve anytime soon. But not that, we only take into account current reserve and not other potential reserve, be it in Bohodopi, Pomala, and Sorowako. Aldo, could you help me explaining the second catalyst?
Okay, sure, Naomi, thanks. In the second catalyst, Inco's right long future is also supported by near future of nickel, as we are expecting further drop in nickel ore supply. Indonesia implemented ban on the export of low-grade nickel in early 2020. This ban by Indonesian government causes global nickel ore supply to drop by 15% in 2020 alone. However, this drop is not as severe as 2014. At the time, Indonesia did the same ban and global nickel supply massively slowed down by 60%, 4 times the current drop. Thus, we see a potential for nickel supply to drop even further. In conclusion, we expect nickel to turn deficit in the next 2 years. Right now, Indonesia is not showing any sign of nickel ore export ban easiness. This will become a problem for China, since they mostly import its nickel from Indonesia with around 70% shares. We believe that Indonesia's lower supply from the ban and lower global nickel production in general will make the nickel supply to deteriorate even further on the back of strong nickel demand due to EV rise and stainless steel recovery. In our view, this deficit will push the nickel price upwards. We expect average nickel price of 14,500 USD in 2020 and then ramping up to stable at 17,500 USD from 2024 onwards. Remember that Inco's sales volume is fixed and the pricing is based on LME nickel price. Based on that, this soaring nickel price will massively help Inco's performance. Moving to the next catalyst. In response to the other catalyst, Inco is actively doing expansion to take advantage of the tailwind in nickel industry. Mine ID, Indonesia's state mining holding, looks to improve the nickel industry by adding stake in Inco by 20% and later to form Indonesia Battery Holding with 25% stake. This is a good thing for Inco as they gain government support. Not only from government, Inco also collaborate with strategic partners in developing Bahodopi and Pomala sites. The details can be seen on the table, with the main point being Inco will have diversified product portfolio that serve both stainless steel and EV battery market. With all the strategic expansion, Jupri, could you help elaborate more on Inco's financial analysis?
Sure thing. Thanks, Aldo. Now, those broad catalysts translates very well into Inco's financial measures. First, on its profitability, we expect Inco to post a 6.6% revenue growth in 2020, thanks to the positive nickel environment. For the next 5 years, we expect revenue to grow at solid 5.5% CAGR. Inco's vertically integrated business model is reflected on its profitability margin, where we expect in 2020, Inco's EBIT margin is 13%, but growing to average of 20% in the next 4 years. This net punchy net profit growth of around 10% CAGR for the next 5 years. The second one is Inco's healthy balance sheet, where Inco has been consistently managing their debt very well, and now is a zero gearing company. In addition, Inco has successfully administered its cash flow management, deriving a CFO of around 20 to 30% of its sales. In short, Inco is able to deliver a promising and intriguing cash flow from its operation. Inco also is allocating its Capex for maintenance on the fourth furnace this year, where we expect Inco's production to drop by around 4,300 KTPA. However, this drop is covered by huge boost on nickel price. So we project Inco's revenue to still growing around 13% in 2021. We also project Inco's production to reach around 78,600 in 2025, below company's guidance of 90,000. We took into account further impact on forcing and overmining, which could cause lower production in the next few years. This is reflected on Inco's production since 2015. In terms of valuation, our conservative valuation arrived at a target price of 5,000 rupiahs per share, driven by DCF model and PB multiples with 50-50 weight. DCF is used due to the nature of Inco's business and visible future cash flow performance, whereas PB multiples is used given the strong correlation between Inco and nickel price. Thus, as the fluctuation on nickel price is inevitable, we believe that combining this method is justified and could derive the true value of Inco. Let's dive deeper into these two methods. The first one is multiples valuation, where we arrive at a target PB of 1.9 times, representing Inco's +2 standard deviation on PB band. We think this is justified, given that Inco's share price movement correlation with LME nickel price in 6 years is the strongest compared to other variables. This is also used to capture the nickel boom period in 2014 to 2015. The second method is DCF, where we forecast 25 years forward until the end of concession and reserve in 2045 with a terminal value, and this is still a conservative valuation. The cost of equity is derived from CAPM, risk-free from Indonesia's 10 years government bond yield, and conservative without using US, and market premium is using the Modern numbers. Beta is calculated using 5 years weekly numbers of Inco's price, regressed with JCI. For the terminal growth, we use 0% due to the limited reserve of nickel in nature and a limited concession period. These numbers translate into a WACC of 15%. Despite our confidence in our call, there are still key risks. Aldo, could you elaborate more on the risk?
Okay, thanks, Jupri. Despite the hype, it is still very possible that the realization of EV doesn't go as fast as expected, which become a threat for Inco. To face this, Inco diversified its product portfolio, therefore adding option to sell their product on the stainless steel market. And the second threat is China. China is the biggest consumer of nickel. This makes any decrease in nickel demand from China will become very impactful for the market. To mitigate this risk, Inco maintain their relation with their must-buy customers, therefore their sales volume will remain stable. And then the third one, Inco's share price is highly correlated with LME nickel price. We calculate 3 scenarios, bull, base, and bear case, with target PB and LME nickel price assumption as follows. You can see on the top left, bull scenario with PP of 6,000, bear scenario with 5,000, and bear with 4,400. To mitigate this risk, Inco tries to improve their vertical integration business model, therefore lowering the operational cost and maintain better margin against peers. In conclusion, we initiate a buy recommendation on Inco with target price of 5,000 rupiah per share, representing an upside potential of 17.1%. Lightning fast EV adoption, expected further drop in nickel ore supply, and prospective strategic expansion are 3 main reasons to serve along with Inco to face the rising wave of EV. Thank you. The floor is open for Q&A.
Hey, hi, team. Flossom, pretty awesome presentation. Yeah, it's interesting. There's about 3 teams here choosing Inco. It's probably the hardest and also the easiest from a thematic perspective. Probably hardest in terms of what they're actually trying to do to benefit from this. So, could you actually bring me through why you choose?
To cut the question.
Yeah, could you bring me? Hi, can you hear me?
Yeah,
we can hear you.
Thank you,
well,
delegates, for finishing the presentation in time.
Hello. Hi.
For the presentation.
Okay.
Now, let us begin the Q&A session, which is limited to 10 minutes, and it is open for panelists only. Delegates are allowed to discuss before answering the question. Panelists, you can start asking the delegates from now.
Okay, I'll just continue with my question, guys. Yeah, it's just interested to see why do you choose such a high weighted average cost of capital? It seems to be 15%.
Yeah. Okay. Thank you for your question, sir. This is actually, we use a very conservative calculation with our WACC because we use a risk-free from Indonesia's government 10 years bond yield, right? Not the US. Because if we use the US 10 years government bond yield, the WACC will decrease to around 5 to 6% only. We also use the macro risk premium of 8%, which is pretty large. So due to that, we gain a pretty large WACC. But we remain conservative on our calculation, given to the fact that there's still lurking uncertainty in the nickel and EV penetration in the market. So even our conservative calculation still derive a buy call on INCO. Hence, we combine this conservative with our positivity on the nickel price as well. We use Indonesia's government bond yield as well to take into account the uncertainty in regulation, given to the fact that currently Indonesia still banned the export of nickel ore in the export market. So this is a very conservative calculation. But if we use the more aggressive way, the WACC will go down to around 6 to 7%, more or less.
Got it. And you mentioned early on your report that that they're intending to do Capex in both RCAF and HPAL, right? Starting next year. I'm guessing that you're not putting it under your forecast estimates because there seems to be no debt.
Yeah, we use it. We put that into account. Sorry, let me think it's somewhere around here. Sorry. Yeah. Production. Sorry, let me just find it first.
No worries.
Yeah, just to okay. I think it's somewhere around. Sorry, I couldn't find the data, but we did put the calculation into our forecast where we projected in 2020's 2021 production will go down to around 4%. Hence, we project the here you go. So we project that nickel Iman production will go down by around 4%. But we did not calculate that into the debt because INCO's cash flow is still relatively good. With cash flow from operation, it's around 20 to 30%. So INCO is able to deliver around, in 2021, we expect its cash to remain around 300 million, where according to the company, they will use approximately around 100 to 200 million US dollars, where we expect that they will not, sorry, sir, yeah.
No, I didn't make a comment. Sorry. Go on.
Okay. So yeah, so we expect the company will not take any debt on the corporation that will be conducted in 2021.
Okay. So sorry, you expect the company is not taking debt because of?
Yeah.
Well,
okay. So their maintenance is actually supposed to be conducted in 2020, but it's delayed due to the COVID, right? But their maintenance is expected to cost around 100 till 200 million US dollars. However, as we see the cash flow from the company, from its cash condition, we see that this is still very positive. Thus, we do not see any potential for the company to finance their capex on the fourth furnace. So that's our.
What about their RCAF and HPAL projects that you mentioned?
Okay.
That they might.
Yeah. Okay. Another reason why we use very conservative calculation is due to the fact that they are not disclosed any details on the expansion on the Pomala or even in the expansion. They have not disclosed any details on the Pomala or Bahodopi. Okay, maybe if you can calculate that its investment will be roughly around $4 billion US, but Inco will only take minority stake, where we expect actually it's around 25 to 49%. If I'm not mistaken, the formula is 25%. Hence, this is still not disclosed yet, so we did not put this into our calculation. But even if this is true, and our calculation suggests that their debt will only reach up to around 0.3 times, 30% debt to equity ratio. But this is will be represented in their financial maybe in 2022 to 2023. So yeah, but this is still very uncertain. Hence, we did not put this into our calculation.
Thank you. That's a very clear answer. I'll let the rest ask.
Thank you, sir. Appreciate it.
Hi, this is Ricardo from Indica. I have two questions. The first one is, why do you think that price to book ratio is relevant to do valuations for mining company like Inco? And secondly, you have such a rosy story going forward, but if we look at your forecast, actually your numbers is pretty unexciting. I mean, the next 5 years, your revenue growth is less than 20%. This is cumulative as well as your earnings. I don't see any some tally between your story and your numbers.
Okay. Thank you for the question, sir. So as you can see on the screen, this is Inco's PB and LME nickel band. We use Inco's PB to take into account the correlation between Inco share price and LME nickel band, where we calculated the 6 years correlation. It was 0.96 times, very close to 1. So we can see that it's actually highly correlated. Hence, this is much more correlated between other multiples such as PB or even EV reserve. So we use this to take into account the hype on the LME nickel price. That's the first one. To add something, maybe we can just let me just take our calculation on the EV reserve as well. As you can see,
what is the correlation numbers?
Okay.
Well,
okay, sorry.
that is one thing. What is the correlation numbers?
Sorry, sir. Just to clarify, the correlation numbers between PB and LME nickel price. Yeah.
From 1 to 0. From 0 to 1.
Yeah, the correlation is 0.96 times.
You sure?
Yes, I have the calculation.
Okay.
Yeah. Yeah. So this is on the PB band. The second one is we take into account EV reserve as well, but EV is not used due to the different methods might be used in calculating reserve from each companies. We take into account global and domestic, global companies, region companies. So we did not use this as our calculation. Okay. On the second part, on the on the why our numbers is not very exciting, right? So we take 3 scenarios. We take bull, base, and bear case, where we expect in the bull case PB, our PB target is 2.1 times. This is equivalent to the PB ratio on 2014 to 2015, where now the price is actually has gone up above our target price. And why we use base PB of 1.9 times, and the calculation is not very exciting because I'm going to reiterate this again. This is our very conservative calculation. We do not want to put our very optimistic calculation on this call, as well as we do not want to put our very pessimistic calculation on this call. So that's why if our calculation goes up to, if the LME nickel price is up by, say, 10%, we did a sensitivity analysis on that, and the result will be every 1% of increase in nickel price is equals to an increase of 7% net profit, 5.8% of EBITDA, and 2.3% of our target price. Hence, let me reiterate again, this is a very conservative calculation. We remain bullish on the industry overall, but we think that the current is still overhyped, hence reaching our bull target. Sorry, hope that answers your question.
Okay, I'll let the other judge ask.
Thank you, sir.
Hi, Flossom team. So thank you for the presentation. So I have a couple of mine ID owners. Them now owning stake in Inco. Do you think that there could be any impact on their strategy going forward? And then second question, it's on the kind of management delivering in terms of the production and an expected ramp up, because I assume that you already baked in some of the improvements in the next few years. Thanks.
Okay, so sorry, just to clarify your first question, was it about mine IDs going into the INCO and the impact? Is that the question?
Yeah.
Okay. Okay. Yeah, certainly there will be an impact, positive impact, in fact, of the mine IDs going into the INCOs. So INCO's concession period will end in 2025 on their contract of work, but we expect there will be, as INCO's ownership now consists of mine ID, we expect now that INCOs will gain another 20 years, i.e. 10 years, double 10 years extra additional concession period. This is why we forecast our DCF to 25 years forward. We do not use any terminal value in it because due to the fact that we remain positive on the fact that INCO will gain another extra contract of work. That's the first one. Sorry, sir. On the second one, were you asking about the production for INCO for the next 5 years?
Yes, and also like in context of in the previous years, right? In terms of how the delivery has been versus the management expectations.
Okay. Okay. Thank you for the question. So in regards to the production, we actually did a calculation from 2011, where it has been a very fluctuative numbers. The highest is in 2014 to 2015, where they produced about 85,000 nickel inmet in 1 year, whereas their production capacity is around 75,000 only. So they over mining their production by around 15%, 13 to 15%. But the numbers after the 2 to 3 years is go down by around 68 to 30,000, 70,000. But the company last year, they mentioned something about they want to ramp up their production up to 90,000. Okay, so in the next 5 years, they will ramp up their production until 90,000. This is the numbers above their highest production number in 2014, 2015 of around 85,000. But we do not take this into our calculation because we see there's a potential, even if they produced more than their actual capacity, their ground will produce some holes, and then their next year's production will deteriorate. That's why this is still a very conservative. This is below company's guidance. We take into account the next 5 years production will go gradually, will increase gradually, but only until 78,000 kiloton. Going forward, our calculation will gradually go down as the reserve goes to zero as well in 2045. That's how we derive the calculation on the production, sir. Hope that answers your question.
I would like to also add on the first question. So not only from positive impact, it will also give some safety for the INCO's industry, because when mine ID enter the stake as well in INCO, it means that the government is fully supports the idea of nickel industry. Therefore, it will protect INCO from any bad permission or any regulation that really makes INCO suffer. Therefore, the INCO will not be in any danger from the government regulation.
Thanks for clarifying.
Okay, thank you, Flosam, for the presentation. I would like to remind, for those who are not presenting, please ensure that your microphone is muted and your camera remains on.
Now moving on, we are going to announce the 4th team that made it to the grand final. We would like to invite Ms. Sabrina Haya as the General Secretary of the 20th ICMSS to announce the 4th team that will be presenting next.
Good morning to all panelists and delegates. My name is Shabin Rahaya as the General Secretary of the 20th ICMSS. Now I'm going to announce the fourth team who will be presenting in the grand final of the 20th ICMSS is Congratulations Gulf Capital for making it to the grand final. Please prepare your presentation and make sure to turn on your camera as you present your equity research report to the panelists and other delegates. The representative delegate may start screen sharing your presentation window now. Thank you.
Hi, to all the panelists, good
I would
morning.
like to
Just to
remind
make
you that
sure,
the presentation time is limited to 10 minutes. Delegates, you may begin your presentation now.
Even in the midst of disaster, there will always be an opportunity, and our ability will determine how we could refine those opportunities. Distinguished audience, we are from Team Gulf Capital, and this is Vail Indonesia, one of the largest nickel mining companies in Indonesia, established in 1968. Vail has been expanding and has covered one of the largest concession area, totaling 118,000 hectares covering Sulawesi, with a total proven reserve of 66.2 million tons. Vail has been producing nickel metal with the total production capacity of about 80,000 tons per year, and has been selling every nickel metal that they produce to Sumitomo Metal Mining in Japan and Vail Canada. This huge production capacity is supported by Inco hydroelectric power plant, smelter, and shipments, which exhibit strong business integration to encourage efficient business. We from Team Gulf Capital issue a buy recommendation on Inco with a target price of 5,965 rupiah per share, presenting 20% upside from its closing price. Our target price is derived from these three catalysts: Inco favorable industry outlook, Inco as the industry key players, and the company's strong financial position.
Going on to the first catalyst, looking at the macroeconomics, which has been heavily affected by the pandemics, global GDP growth was facing a 5.2% expected contraction. However, the fiscal policy has minimized a greater downside potential, with an actual contraction of 1.7%. Take a closer look at China. The $500 billion fiscal stimulus is also looking promising, which boosted the investment within the country and helps the economy to recover in the second quarter. As one of the main key players in the nickel demand market, with about 60% of the total nickel consumption, China's economic rebound gives a favorable outlook towards the upcoming nickel demand, which is mostly used for the country's stainless steel production. Thus, China's speedy recovery would put the nickel demand to increase in the short term. As the economy will keep on growing, the country tends to use more stainless steel, which has an overall better quality and commonly used in metal products and mechanical engineering rather than the carbon steel. Therefore, based on a sampling of several countries, we found an 85% correlation, which would support our analysis as the economy is expected to recover after the pandemics in the long run. Nickel to be the EV battery main compositions, shifting towards the free emission vehicle, along with the expected EV battery expansion to Indonesia, would support the EV industry to grow at a 36% CAGR over the years and drive the nickel demand in the long run. How exactly the EV industry would drive the nickel demand? For every electric vehicle, which needs around 60 to 100 kilowatt hours, or about 5,000 battery cells, it will require about 40 kilograms of nickel per vehicle. This means the EV market will expand the nickel demand from about 104,000 tons of nickel in 2021 to 440,000 tons of nickel in 2026. The EV industry expansion is also supported by government policies in many countries, starting from the tax incentives until the ban of polluting cars in the US, Europe, and China, which would strongly help the EV expansion growth. Therefore, based on China's speedy economic recovery and the stainless steel consumption, along with the EV industry growth opportunities, we believe this will set the nickel demand to increase in the future at a 5.8% CAGR, faster than its historical growth of 3.5%.
Having a look at how stainless steel and EV influence the nickel market, now let's take a look at how the companies will supply the increasing demand. Indonesia was the key exporter of nickel in the global market, exporting 29% global production in 2019 alone, supported by its enormous reserve, which comprises 24% of total global amount. But recently, the market has been undersupplied because of the Indonesia export ban on raw nickels. The miners are now unable to sell the products as processing facilities are still lacking in Indonesia. Thus, Indonesian nickel production decreased by 22% in 2020 alone, leaving the global market with a huge supply gap. Furthermore, other key players are experiencing capacity growth constraints. Philippines and Russia, which are the second and third biggest producers after Indonesia, are forecasted to only grow their production 3% and 1% respectively, caused by limited discoveries, capacity limitations, and economically invisible resources. Considering all the constraints, supply is forecasted to grow 4.4%, while consumption outpaces it at a whopping 5.8% growth. We forecast that the nickel market balance will shift to deficit in 2024, and with all these factors weighed in, nickel prices are expected to rise to $7,500 per ton in 2026. Fortunately, Inco will be able to maximize the opportunity with its competitive advantage. Inco is expanding its production facility to 90,000 tons by building an additional RCAF smelter, along with its favorable long-term contract to VCL and SMM, and its divestment to Mine ID. Now, Inco will be able to take advantage of the increasing nickel prices. All in all, the strong growth in nickel price and the increasing sales volume will enable revenue to reach 6.08% CAGR in 2018 until 2026.
So let's move to the next point. With the favorable outlook it has, Inco is also supported by a strong financial position. Inco has a well-integrated vertical business process, which allowed them to have low cash costs at 68.2% of its average selling price in 2019. Along with the newly converted 3 hydroelectric power plants, make the company less dependent towards the fuel and coal prices. Therefore, we estimate the company cash cost to decrease 7.25% in 2019 until 2026. As Inco will be benefited from the increasing nickel prices, additional aircraft smelter development along with a more efficient cash cost, this will underpin Inco's net margin expansion of 300 bips. On top of that, Inco has a better EBITDA margin of 28.35% above its peers, which only averages at 14.82%, which reflects the company's competitive edge. Inco's superior profitability margin is supported by a solid liquidity in current ratio, along with the company's zero debt strategy to support the further expansion. Inco's strong financial position allows the company to have a long-run profitability, as seen from the improvement of cash flow from operation by 14.35% CAGR and better position on the upcoming project expansion. Inco will boost their production capacity as the company aims to increase 10,000 tons by 2023, which will have an impact on rising Capex to sales to 20.14% in 2021-2022 as the expansion takes place.
In line with Inco favorable industry outlook, the company as the industry key player and its strong financial position, we arrive at our target price of 5,965 rupees, presenting 20% upside from its closing price. We use the terminal multiples, discounted free cash flow to equity approach, along with the EV/EBITDA multiples by using 50% proportion each. On calculating the DCF, our cost of equity derives from 2.8% risk-free rate coming from 10-year Indonesia government bond denominated in US dollars, along with the 6.3% market risk premium and 1.4 stock beta. On calculating the terminal multiples, we use the company target price to earning ratio of 19.6 times adjusted to its peers' average multiples, and arrived at our DCF target price of 5,667 rupiah. And by using 10.1 times EV/EBITDA multiples, we arrive at our multiple target price of 6,263 rupiah. Therefore, by combining both valuation comprises 50% proportion, we arrive at our stock target price of 5,965 rupiah. Due to the limited amount of comparison in Indonesia, we select a few regional peers to compare the company based on its similar business practices, and found that Inco is currently traded at a slight premium, but has much better profitability. Thus, we believe that the company would unlock a better upside potential, along with the expected nickel demand increase. Our football field analysis also still shows an attractive upside potential of the stock. To confirm our valuation, we conduct a Monte Carlo simulation and still come up with a promising 75% buy recommendation.
And despite the strong prospects, Inco also faces inherent risks. Based on our tornado analysis, nickel price have the greatest impact, followed by changes in cash costs, exchange rate, and sales volume. Nickel price volatility is affected by macroeconomic conditions, which become the key risk of the company. Inco also faces market risk from fluctuation on fuel prices, which we have conducted stress tests for both market risks as shown below. Production halt and decline are also a part of operational risks, which could affect production volumes. As a mining company, failure to comply with environmental standards would also hinder the permit extension process. Considering all the given risks, our blue sky scenario shows a 42% upside and 30% downside on our gray sky scenario. Both of our scenarios assumptions are shown in the right side of the presentation. All of INCO's growth strategy and risk management are done by competent and experienced management, complying with good corporate governance and sustainable mining standards.
Therefore, based on INCO favorable industry outlook with long-term nickel demand growth, Indonesia as a key player in the nickel industry, along with an advantage from INCO business process integration and the company's strong financial position to support the further expansion. And after considering all the possible risks, we are issuing a buy recommendation on Fail Indonesia with a target price of Rp5,965 per share, presenting 20% upside as Fail Indonesia refining the opportunities. Thank you.
Thank you, delegates, for finishing the presentation in time.
That will be the end for the team's presentation. Now, let us begin the Q&A session, which is limited to 10 minutes, and it is open for panelists only. Delegates are allowed to discuss before answering the questions. Panelists, you may start asking the delegates now.
Thank you, Gulf Capital team. This is Ari from Macquarie. Just a question here on the valuation methodology, right? So it seems like the methodology is based on the blend of EV/EBITDA and then DCF. But then if I look at the front page, it looks like it's suggesting an implied 20 times P multiple. So basically, just want to get a better clarity, right? Which valuation methodology that we should be focusing on here? Either, because you assign 50/50 and yet the implied you focus on the P instead. So I just want to get a better understanding on the thought process on valuation. Thanks.
Sure. Thanks, sir, for the question. So to clarify, we use two methodologies here, the DCF valuation, whereas the terminal multiples discounted free cash flow to equity, along with the EV/EBITDA multiples. So for the PE that we explained before is for the terminal multiples that we are going to use on our DCF. The reason why we use the terminal multiples instead of the terminal growth is because of, as we have known, currently the pandemic has really pressured the global economy. However, the nickel market is still increasing due to the nickel ore ban export by the Indonesian government in the early 2020, which hold the supply of the nickel and decrease the nickel supply in the market. However, the demand of the nickel is still increasing as China has recovered the economy in the second quarter, which is the largest nickel consumers for about 60%. So we believe that to capture the ongoing, the current market situation, we need to use the terminal multiples instead of the terminal growth for the company. And for the EV/EBITDA, we use it to capture the market perspective towards the company. So we believe that both methodologies is the appropriate approach for the company to capture both the market perspective and the company performance in the current situation. Thank you.
Got it. Yeah, I think that basically the implied multiple would be used. Would be good to have consistency, right, on the EV/EBITDA as well. So the second question is in regards to the kind of the risk reward you see in the stock, right? Given that the stock has a nice run in the past few months. So basically, how do you see the downside risks play out on your forecast? Thank you.
Thank you, Mr. Ari, for your question. I'll try to answer this. So just to make sure on our valuation, we need to we've done scenario analysis on our valuations, in which our valuation at this target price of 5,965 rupiah is our base case scenario. We've also conducted blue-gray sky scenario, which reflects the macroeconomic conditions, in which the blue sky shows the upside potential of 42% Actually, our blue-gray sky scenario is one of the scenario that is relevant to this year's current nickel price, LME nickel price, which is around 18,000 LME nickel price. But just to make sure, we have also assessed the downside potential of the INCO, as we see that nickel prices throughout the 2021 will still be averaging on our base case scenario of 16,000 or 16,500 USD per ton. I'll just bring up my assumption, our nickel price assumption. So yeah, okay, so this is our base case assumption, in which in 2021, we forecast that the nickel price will average throughout the whole year at 15,500 USD per ton. Of course, this is well below the current nickel price, but we see that the nickel price is driven by the short-term momentum, especially by the decreasing inventories in the Shanghai Future Exchange, in which the inventories will, we believe that in the inventories is the main key drivers why the LME nickel price surged in the last few months. But we see throughout the whole year, we forecast that Philippines and Russia will also ramp up their productions back to pre-COVID conditions, and therefore we see that the nickel prices will still average on near our base case scenario. And even if we have even after assessing all the downside risks, we still believe that our target price in our base case scenario of 5,965 rupiah is the best target price for INCO.
Got it. Thanks for clarifying, and then I'll leave the other panelists to follow up. Thanks.
Thank you, Mr. Ari.
Hey team, like your scenario analysis that you did, gray sky, blue sky, really useful to get a handle of where prices should be. Can you bring me through your cost breakdown analysis? I think you mentioned fuel is one of your largest costs, right? And you have a pretty stable kind of cost outlook. And just generally, what are your views if oil price has been rallying off late, and with all this recovery story happening, what are the risks that oil price can go down to $70 and that therefore affects your valuation?
Okay. Thank you, Mr. Andre. So this is our cash cost breakdown, in which we've forecasted. So there are our two main drivers for the decreasing cash cost, in which we explained before in our third catalyst. We believe that the INCO's cash cost in the near future will still decrease. Will still decrease by 7% and throughout until 2026. We have two main drivers. Because first of all, INCO is now more independent towards fuel and coal prices. Why? Because as we've seen before, INCO has 3 hydroelectric power plants in which they could generate 365 megawatts of electric power annually, and those 365 megawatts generated is fully able to produce the electricity needs for INCO's production in the smelter. So INCO's right now is more independent and towards the fuel and coal prices, in which they are more effective in the cash cost breakdown. They will require less fuels and coals compared to their peers, and that's why we believe that even though that the coal price and the fuel price is increasing, INCO's cash cost will still hold at around 6,800 and 6,900 USD per ton.
Maybe I can add some point from Owen. So INCO is also supported by a strong financial position, right? And INCO has a well-integrated vertical business process which allowed them to have low cash costs, like I mentioned before, at 68.2% of its average selling price in 2019. And after the maintenance of hydroelectric power plants, it will make the INCO will have less dependent towards the fuel and coal prices. So we estimate the company cash cost is stable after the maintenance of the La Rona Canal in 2019.
Got it. Got it. I guess my question is more like at $6.50 per ton of cost. What kind of oil price are you assuming? And if oil price were to go back to $70, what will that cash cost be?
Okay, Mr. Andre. So, if the coal prices gets back to the
oil price, yeah.
Coal price. Okay, so we've also taken into account of that on our gray sky scenario, but that scenario, please just bring that up back for a moment. Yeah, so we've also conducted a cash cost stress test in which in this stress test we've taken into account if the coal prices rise back, each increase, each 4% in 10% increase in cash cost would decrease the target price by 18%. So in this scenario, without taking into account the increase in the coal prices, of course, that when the coal prices increase, we would change our valuation recommendation, not taking into account the increase in the coal prices. So based just on the stress test, solely on the coal prices, 10% increase in cash cost would decrease the target price by 18% without taking into account the nickel prices once again.
Got it. Thanks for that. The other is just wondering, on valuation basis, have you looked on EV over resource or reserve basis versus their other nickel company peers?
Yeah. So we've tried to take into account the EV reserve methodology, but just because Inco is one of the special company, we can say that Inco has a significant advantage compared to other companies, especially other regional peers such as the Nickel Asia and the Nickel Corp in Australia. Inco has a very significant reserve, and that's why after we've taken into account the EV reserve methodology, we feel that it is not meaningful for us to insert the EV reserve because Inco's once again Inco's production and also if reserve resources are too big to are very big, and compared to other companies, it will not be relevant for us to do in this valuation.
Got it. Thanks for that. I'll leave the question to the others.
All right.
Thank you, Mr. Andre.
This is Ricardo from Indica. Could you tell us any changes in terms of dividend policy after the government also has some stakes in Inco? And secondly, how flexible is the company can adjust productions in the medium and in the short term and medium terms?
Okay, can you open the appendix for the dividend policy, Owen, on the appendix? Yes. So we have been taken into account the potential dividend that will be paid for Inco to the shareholders, considering that Inco is now owned by the state-owned company, the Mine ID. So we believe that there will be a higher chance for the company to pay dividend along with the increasing nickel prices, which will boost the revenue of the company and the earnings of the company. So due to the, after considering the higher potential income and become the state-owned company, we expect the company would pay out the dividend payout ratio the same as it back then when in the 2010 and 2014, where the nickel prices is increasing before falls down. So we have conduct the forecasted dividend payment at the 17.9% CAGR over our forecasted years, and we believe that this is going to be appropriate as Inco is now owned by Mine ID after they put stakes in the company.
Also, I can add some point from Fernando. And for the short-term production capacity, Inco production capacity is forecasted by adjusting production to normal level before constructing and maintenance of La Rona Canal. And Inco has succeeded in increasing the water flow to 5 cubic meters per second And based on the assumptions, we forecast the production capacity to increase by 2.5%, 3%, and 2% in 2020 until 2022. Inco will boost their production capacity as the company aims to increase 5,000 tons in each year in 2023 and 2024 for the develop an RKF smelter development.
I see. I'm good. Thank you.
Okay, thank you, Mr. Ricardo.
Thank you, Mr. Ricardo.
Thank you for the presentation. Thank you for the presentation. I would like to remind for those who are not presenting, please ensure that your microphone is muted and your camera remains on.
Now we are going to announce the 5th team who made it to the grand final. We would like to invite Mr. Amukantar Fikriansyah as the General Treasurer of the 20th ICMSS to announce the 5th team that will be presenting the research.
Hello everyone. The next team who will be presenting in the grand final of the 20th ICMSS is Independent Ladies. Congratulations for making it to the grand final. Please prepare a presentation and make sure to turn on your camera as you present your equity research report.
I would like to remind you that the presentation is limited to 10 minutes. Delegates, you may begin your presentation now.
Greetings, dear honorable panelists and committees. In this precious moment, Independent Ladies want to present you our analysis towards Petrified Indonesia Tbk with ticker INCO, and we would say it's nickel at a premium. Why? Our recommendation is hold INCO with a target price of 5,425 rupiah. We can give you this recommendation because we strongly believe in these 5 points here. In advance, we would like to say that INCO has an exceptional performance in the future because of the prospect of electric vehicles and the quality that INCO's hold, but INCO's price has priced in. Also, the expansion, level of production, and the timeline that this EV will be produced, and you should be our concern. Looks like we need to wait all night long. We want to introduce Petrified Indonesia. The main product now is nickel made. Based on the revenue breakdown, INCO only sells their product to 2 companies, which are Valuation Limited and Sumitomo Metal Mining. INCO's costs are used for its mining activities, and the largest contribution is the cost of fuels and lubricants. INCO's shareholder structure was held by Valuation Limited, which was really dominating, and it also held by other companies and the public. Some may be guessing, what is nickel matte anyway? What's the difference with any other ordinary nickel? Nickel matte is the intermediate form of nickel metallurgy that contains 70% of nickel. The uses are to produce pure nickel metal, stainless steel, and can be used for lithium-ion batteries, and yeah, it's for electric vehicle batteries. And surprisingly, as Indonesian, we should be proud because Indonesia had the largest contribution for global nickel production in 2019 by 23.7%, and INCO contributed 7.5% of the world's nickel supply in 2019. That's for the quantity. As for the quality, INCO has 1.79% nickel ore content if compared with global nickel production, which only has 1.58% nickel ore content. In 2014 to 2015, INCO had the highest nickel production contribution in Indonesia, but it has now been overtaken by IMIP, and predicted the contribution will slow down over years. According to Reuters, nickel prices have reached their highest level in 2019, but the LME price is predicted to continue its upward trend in 2021 to 2025. Nickel price movements are influenced by nickel demand and supply. The supply side comes from the huge potential of nickel in Indonesia that attracts some foreign investments. But the government has implemented a nickel ore export ban in January 2020. However, this policy can hamper the production process of stainless steel and EV producing countries. Then let's move to the demand side. Demand for nickel has the potential to increase in the future. One of the driving factors is China's fast recovery during the pandemic. That means the pending infrastructure project will continue and boost stainless steel production. But the COVID-19 has not abated, the situation giving an uncertainty of China's economy. China's stainless steel production affects the demand of nickel because stainless steel has 71% proportion of the total nickel demand in 2019. In addition, China is the largest producer of stainless steel, around 51.6% in 2019. Nickel demand is also pushed by electric vehicle cells. Here, the US controls the market share of EV cells. Based on the latest forecast, EV cells will increase significantly until 2030. Biden, as US president, is predicted to increase EV cells. His policy focuses on renewable energy and green investment. This situation can increase the absorption of total nickel production for EV batteries to 30% in 2030. This positive sentiment also came from within the country, where 3 SOEs will build an EV battery factory in Indonesia. The factors that cause the movement of nickel demand and supply will cause a gap in the long run. According to McKinsey, Class 1 nickel will experience a shortage in supply in the next 30 years. It will increase the nickel prices. Oil price also affect the cost of revenue of nickel producing companies such as INCO. Based on Bloomberg, the oil price is predicted to be stable in 2021 and 2022. This is a good sentiment for INCO to stabilize its cost of revenue.
As we know that environmental issues are the biggest concern of all governments in the world. INCO comes as the pioneer of sustainable energy development in Indonesia, which uses energy hydroelectric power plants to substitute HSFO and notably can lower steam production costs. And here's the result. And if we see from INCO's environmental and social responsibility, INCO has applied the standards for their operations and received some awards. INCO also has notable BOD and BOC with the best experiences. And talking about cost efficiency from its hydroelectric power plants, INCO also does their cost efficiency from their sales with a bond contract with VCL SMM. So no need to worry about doing a lot of marketing activities, and we should keep in mind that VCL SMM have a good track records.
Based on above factors, we believe INCO has a strong growth prospect with a reinforced total production and increase in revenue due to increase in price. Here is our revenue forecast assumption. Following sales are based on production that are determined by production capacity, nickel grade availability, and operational smoothness. Average realized price are discounted LME price at historical averages. Next, our financial analysis of INCO to support hold recommendation. INCO has a solid financial structure, high solvency, and strong liquidity. The capital structure is deleveraging each year and has a high current ratio. Now, how about the profitability? We expect a strong profitability. INCO will have higher margin and increase ROA due to higher prices. This will also be supported by robust demand to boost sales that will increase total asset turnover. Historically, INCO has better margin than peers, although experiencing tough times during 2015 to 2017. After nickel prices recovery, INCO managed to recover its margin greatly from 2018 to 2019. Next, although increase in production capacity will increase cost of revenue, cost efficiency programs will consequently increase ROA. Its expansion efficiency is supported by its capital investment, backed with efficient capital use together with high cash generating abilities. Next. However, there is an offset between production capacity escalation and maintenance activities. Although there will be demand for nickel, INCO's production might lag behind in grasping the opportunity as its sales are constrained by production. We found two main production factors, which are high nickel grade availability and smoothness of the operation. Thus, we believe production will increase slowly to 90,000 by 2025.
Then to valuation, we use discounted cash flow and relative valuation to value INCO stock price. Next. As for the this year valuation, we use free cash flow to equity, considering that INCO's capital structure is heavier on equity. We calculated its cost of equity using CAPM with 6.16% recipe rate in Indonesia, 2.94% market risk value, and 1.59 beta of INCO. We came up with 10.68% cost of equity. We use 10% terminal growth assumption since nickel as one of many components is limited in nature. We arrived at a target price of 4,863 rupiah using this method. Next. As for the second method, we use PE multiple to value INCO towards peers and including market expectation. We use 5 years multiple average PE with 0.5 standard deviation to arrive at target PE for INCO. We also use current PE and EPS in 2020, then came up with a target price of 4,967 rupiah, and it is already priced in. Next. We combine both methods with the equal allocation. We finally reached a target price of 4,435, and it happened to hold recommendation. We set the recommendation on buy if the target price is increased more than 10% from the current price, sell if the price is decreased more than 10% from the current price, and hold between it.
Judging from its relative valuation, INCO is considered overvalued because the PE, PBV, and PS ratio were above the average. We also analyzed INCO with the blue-gray sky scenario. Blue sky is the best case when COVID-19 vaccine has been distributed well. The worst-case scenario is the gray sky that comes from the rate of virus mutation and ineffective distribution of the vaccine. It may slow down the economy. We did Monte Carlo simulation and ran 50,000 simulations based on 4 variables such as nickel ingot production, LME nickel price, exchange rate, and sales volume to total production. Based on this model, we get 51.42% hold recommendation. Next, my team will describe the investment risk.
We found 8 investment risks that will affect INCO shares price. The first market risk, economic slowdown, hit the economy on both production and consumption. This will impact the demand for nickel. However, INCO has secured long-term sales with PCL and SMM, which secures long-term demand. Nickel price volatility will have a high impact on INCO production, because INCO solely focused on nickel. A 5% change in price will cause 12.5% change in estimated earnings. 25% of INCO's cost of production averages in full cost, which a 5% change in price will cause 8% change in estimated gross profit. This is mitigated through efficiency improvements. Expiration and decline approval of INCO's contract of work extension will affect INCO's sustainability greatly, as production and expansion plans will be delayed or even cancelled. Thus, INCO mitigates this by fulfilling Call 2014 amendment and strengthen compliance through divestment of Mine ID. Thus, based on our analysis, we recommend hold at target price of 5,425 rupiah. Thank you.
Thank you, delegates, for finishing the presentation in time.
That will be the end for Independent Ladies' presentation. Now, let us begin the Q&A session, which is limited to 10 minutes, and it is open for panelists only. Delegates are allowed to discuss before answering the questions. Panelists, you may start asking the delegates from now.
Yeah, thank you, the Independent Ladies, for the presentation. Nice one. So just the key question for me in terms of the rating, right? Seems like you're a bit cautious on valuation. So why stick with a hold rating instead of a sell? Thank you.
Thank you, panelists, for the question. Based on our valuation, the INCO stock price already priced in. The market is overestimated because of the electric vehicle prospect, but we need to wait a really long time for these electric vehicles to be adopted in our life and used by people all over the world. And there is also a trade-off between expansion and the level of production that can be a challenge for INCO. And the electric vehicle sentiment will also actually benefit other peers rather than INCO somehow, because other peers is a step on enterprise. And if we look at the production itself, actually it's for the INCO slowed down over years rather than the peers.
So why not have a sell rating instead of just a neutral rating? So we have a more higher conviction call.
Okay. Although there will be problems on the thing that Farhan has already explained, we believe there are still prospects, and there are also prospects for EV, although it will be implemented in a long time. We believe that there is still some prospect in INCO, therefore we choose to hold rather than to sell. And also this is supported by our Monte Carlo analysis. Yeah, we ran 50,000 tries, and we found a hold of 51.42% instead of sell.
And if I may add, actually, for Indonesia, I think higher quality of nickel is needed for electric vehicle batteries. However, Indonesia's nickel production is still dominated by nickel ore content, and that hasn't been processed anymore. Therefore, Indonesia applies a nickel ore export ban to add nickel added value and carry out downstream activities. There are also obstacles in the supply of smelters that are still lacking, and it is projected that around 48 smelter project will only be completed in 2024.
Got it. Last question from me. Any thoughts on why you use the Monte Carlo analysis instead of other valuation methodologies? Thank you.
We have already run a sensitivity analysis. Can you show us? We already ran a sensitivity analysis, and we found also hold is the best recommendation. So we strengthened it with Monte Carlo analysis, which have more tries, which is 50,000 tries, instead of in sensitivity analysis, which only have 81 tries.
Got it. Thank you for clarifying there. I'll leave to the other panelists to follow up. Thanks.
Thank you.
Okay, thank you, independent ladies, for the presentation. I'm just going through the report. I'm trying to, I guess at the end of the day, like it or not, the correlation with nickel price is pretty high. So I'm just trying to find your thoughts on this, the upside risk if nickel prices LME is going to over 20,000, and what are the scenarios that, what are the events that might result in that? And if that were to be so, then does that mean there's upside to this stock price? So if you can discuss that, that would be great.
Thank you for the question. Please let us discuss it for a moment. Of course, currently nickel price is very high at around 18,000, and we believe that this will push the market sentiment towards nickel, and especially on nickel companies. Therefore, there might be big changes in stock price, especially for Inco, which are one of the biggest nickel companies in Indonesia. Therefore, we believe that because of this nickel prices sentiment, Inco stock price will also rise.
May I add up my ultimate point? So the correlation between the nickel price and the stock price is we do forecasting in our revenue with LME price. So we discount the LME price to get the average price, and then this price is affect with the supply and demand of nickel itself, and the demand is from the electric vehicles sentiments and also the stainless steel from China's production. But in these situations, we concerned with COVID-19 pandemics also, so we recommend recommendation for Inco itself.
Got it. Noted. I'm just basically trying to tally. Yeah, you have some slides on Biden and the others, and you seem to be quite optimistic also on the general demand for nickel. So I'm just finding it hard to tally with regards to your whole recommendation. So so basically you're alluding that nickel price will probably go up. Is that what you're saying, or do we expect nickel price to be not going anywhere or even down from here? I mean, you might be right. I'm just trying to see how you guys think.
Actually, we guess that nickel price get the positive sentiments from the EV cells in the short term. So for the long terms, we still guess that the volatility of the nickel price itself, and from the Indonesia itself, from the Tesla sentiment, Tesla in Indonesia is still in the early discussion. So there is no decisions that Tesla will invest in Indonesia.
And if I may add, actually for the nickel price, we predicted and forecasted that the nickel price will be increased over years until our forecast like until 2026. And then we use actually LME price. And then actually we discounted it like 18.8% because actually Inco only sells their products to companies which are PCL SMM. So we discounted the price. And if we see from the sentiment, we also see the sentiment from demand and supply of nickel for the price.
Got it. Thanks. Got the answer. Maybe the others like to ask.
Right. This is Ricardo from Indica. I noticed in your valuation method that to derive your price target that you use the price multiples target of 50 times. How do you justify that?
Okay, thank you, panelists, for the question. Actually, for the valuation, we use two methods here, DCF valuation and relative valuation. As we use DCF valuation because we want to include the financial performance of the company, both in the past and in the future. And as for the PE multiples, we use it because it is expected that Inco will potentially have greater earnings in the future. And we want to take in the account of that market expectation. And if we see from Inco's price right now, the price is already overvalued and the share price already exceeds a lot of analysts' expectation too. And from this, we allocated 50-50.
Sorry, I think I lost you.
Okay. I will explain it again. Maybe so basically we allocated 50-50 for this F and F valuation, and the RP we use PE multiples because we want to include the market expectation, and we see that Inco will potentially have greater earnings in the future as we forecasted too. And we want to take in account of this market expectation, of course, because of the sentiment of electric vehicles. And actually, if we see from Inco's price right now today, the price is already overvalued and the share price already exceeds a lot of analyst projection. And we may take into account that these PE multiples can due to our forecast.
I see. And your target, if I am not mistaken, your target PE multiple is about 50. Is that correct? Yeah. See, target PE 50 times. So it's roughly almost double from now? So actually there is a huge gap. If you look at based on PE only, then it should be a buy. Is that correct?
Yeah, that's correct.
If I don't have the stock now, what do you suggest?
Please wait 1 minute. We are going to discuss.
Thank you, Panelists, for the question. Actually, if we see as from our valuation, can you get to this evaluation slides before this? Yeah. If we see from the DC evaluation, we forecasted on future cash flow and valuated in cost price worth like 4,863 rupiahs, which is we're committed to hold position. And if we see again from a relative valuation, can you move to slide? Yeah. As for the relative valuation, because this relative valuation, this target PE is based on historical performance and actually market expectation and the forecasted for the from the quarter analysis, and actually the historical performance happened when INCO still had the largest contribution for Nickel Indonesia, as I have explained it before, and but for now and future, I believe that my teammate also has explained about it. And market expectation is also too high for the application of these electric vehicles, but the world still needs a long time to use these vehicles. And for transportation, it's still very convenient to use cars with fuel or diesel. So if actually this target PE is from the market expectation that that is really high, and the past performance that INCOs hold, because they had largest contribution before, but not now for Indonesia.
Okay, I'm good. Thank you.
Due to the limited time that we have, that is all for the Q&A session. Thank you very much, independent ladies and panelists. I would also like to remind, for those who are not presenting, please ensure that your microphone is muted and your camera remains on.
And now, we're going to announce the sixth and final team who made it to the grand final. We would like to invite Mr. Michael Abraham Mukom, as the president of the 20th ICMSS, to announce the next team.
So, the sixth and final team who will be presenting in the grand final of the 20th ICMSS is Timbangan. Congratulations, Timbangan, for making it to the grand final. Please prepare your presentation and make sure to turn on your camera as you present your equity research report to the panelists and other delegates. The representative delegate of the team may start screen sharing your presentation window. Thank you and good luck.
Committee, may we begin now?
Please wait for a moment.
Committee, may we begin now?
Timbangan, I would like to remind you that your presentation is limited to 10 minutes. You may begin your presentation now.
COVID-19 has managed to wreak havoc in the economy, and it hasn't been forgiving too for the retail industry. Indonesia's GDP and retail sector growth fell hard in 2Q20. Consumer behavior has also been affected as there is a high expected increase of online channel use post-COVID, meaning that retailers will need to adapt aside from surviving through the end of the pandemic. But we believe that the worst is over, and we see a ray of light at the end of the tunnel. Good morning, ladies and gentlemen. My name is Alif, and alongside here with my team, Arwa and Hanif, and today we will present to you our recommendation for MAPI.
As an introduction, MAPI is Indonesia's biggest and most diverse lifestyle retailer. MAPI has over 110 world-class brands such as Zara, Starbucks, Krispy Kreme, Kinokuniya, and The Food Hall, divided into 4 segments, which are specialty stores, F&B, department stores, and supermarkets, and other segments. Not only is it the biggest in Indonesia, MAPI also operates in Vietnam, Thailand, and the Philippines. That being said, what do you think about MAPI? MAPI will be the main beneficiary of the COVID-19 recovery in Indonesia's retail industry. Our team put forth a buy recommendation for MAPI. The decision is based on our 3 main theses. First, MAPI will ride along the vaccine-related recovery. Second, MAPI has strong target market positioning. And third, MAPI has robust brands and online channels. Through the CF valuation method, we came into target price of 900 rupiah per share, translating into an upside potential of 19.2%. Going into our first thesis, we predict that there will be recovery in 2021 that will be led by the COVID vaccine. As of November 2020, Indonesia has already secured vaccine deals with several vaccine manufacturers. Currently, Indonesia has developed a robust plan of public vaccination that has already commenced. Referring to this plan, the general public will start to get vaccinated as soon as early 2021. To add to that, the vaccination progress is slightly ahead of target at 76% progress towards phase 1 completion. However, even though vaccination had not arrived in 2020, the retail industry has received signs of recovery. Foot traffic in retail and recreational spots, which is a proxy for consumer shopping activity, did fall in early 2020, but showed an increase after the PSBB total was lifted at the end of 2020. We also did our own on-the-ground check to confirm our hypothesis on malls with many MAPI stores in Jakarta and Surabaya. And we found out from our media interview several staff that the mall's traffic has picked up to around 70% of pre-pandemic levels, Zara experiencing long queues, and a change in prime shopping time, which are good signs for MAPI. Well, now we know that mass vaccination will ensue in 2021. What's your further opinion on why we should buy MAPI, Aro?
Thanks for the question, Hanif. So, on our second thesis, we see that MAPI has a significant advantage in its target market positioning, with unemployment rate soaring to 7% in 3Q20 and income reduction mainly affecting the lower middle class, whose income is less than 7.2 million rupiah, leaving the upper middle class less harmed, with only 30% experiencing an income reduction. Despite the catastrophic COVID-19 has brought upon the economy, MAPI's target market, which is upper middle class, has represented a better resilience compared to other retailers' target market when passing through COVID-19. MAPI's strong brand positioning will pave the way for MAPI to go back to its pre-COVID level. As you can see from the chart on the left, MAPI's stronghold in premium retailers reflected by its product price, where most of their products are above 200k rupiah, indicating that MAPI target market is the upper middle class. Coupled with an ongoing condition of excess liquidity as people are encouraged to save, which was shown by the uptrend in third-party funds in banks, we expect there will be a pent-up demand that will happen in the future seconds after the pandemic ends. So, with conducive external environment that we project in 2021, why should MAPI deserve to feel the effect of such positivity? Well, on our third thesis, we argue that MAPI's strong brand equity and online sales channel performance will be a significant game changer. MAPI's main force is heavily determined by its strong brand equity, having the majority of the most reputable world-class brand in the pocket. Thinking about coffee in the morning, MAPI has Starbucks. Thinking about comfortable clothes, MAPI has Zara. Thinking about to buy a new phone, MAPI has Digimap.
A simple example about why Mapi is the most diversified retailer in the industry. And even though my pandemic hit and sales shift toward online channel, Mapi has managed to ride the wave of digitalization in order to adapt, shown by the quintuple figure of online sales to sales from 2% to 10% for Mapi and 2% to 13% for MAPA, making Mapi better than other competitors. With our main thesis laid out before, how will that translate into Mapi's financial performance, Alif?
Thank you, Aro. So we believe that Mapi's financial strength will also serve as a reason for our buy recommendation. We predict Mapi will pick up its speedy growth in no time, as we predict revenue will recover to around 90% of pre-COVID level after being hit with a 20% revenue reduction due to the pandemic in 2020. Going forward, we believe Mapi can continue its double-digit revenue growth as the outlook for target market, brand performance, and online channels seems promising. That will translate into a 10.4% CAGR 2020 to 2024. In terms of cost efficiencies, we have also seen that Mapi has successfully trimmed their fate and operated in a leaner fashion during this troubled time, as they impose an OPEX reduction of around 37% year-on-year, showing Mapi's prudent and effective management in the face of crisis. With a bright revenue projection alongside efficient expense management, we believe that Mapi's bottom line pain will only be temporary, as we predict that gross, EBIT, and profit margin will gradually recover with cost efficiencies that will stay after pandemic, coupled with Mapi's online sales bright outlook that will also contribute to higher margin. With EBITDA that will recover to 2 trillion rupiah in 2021, and we expect it to continue to grow by 40% CAGR 2020 to 2024. We think this will lead to a recovery in terms of net income and EPS from a negative territory in 2020 to positive territory of around 90% pre-COVID level in 2021. In terms of balance sheet profile, we see that Mapi debt to equity ratio spiked up in 2020 as they need to issue debt amounting to 1 trillion rupiah and the effect of PSAK 73. But we think that going forward, Mapi's debt structure will gradually improve from 2020 with debt reduction experienced in 2021, and will stay stable as Mapi has expressed that they are comfortable with their pre-pandemic debt level. And our analysis shows that our financial projections are in line with the consensus itself. To value Mapi, we utilize DCF method with two-stage model to find Mapi fair value to all capital providers. We assume a cost of equity of 13.8% and after-tax cost of debt of 10.8%. We also assume Mapi's long-term growth rate of 3.2%. We then arrive at a weighted average cost of capital of 13.2%, and discount Mapi's projected cash flow and arrive at a target price of 900 rupiah per share with a potential upside of 19.2% from November 13, 2020. By conducting a sensitivity analysis of Mapi's WACC and long-term growth rate, we found that our analysis begets a buy rating of 65% and sell rating of only 8%. We also utilize relative valuation to corroborate our valuation. We believe that Mapi's PE and EV/EBITDA multiple will reverse to its mean. As of November 2020, Mapi trades at 15.1 times PE, a significant discount if we compare to its 2019 PE with an average of 19.9 times. And with recovery that we see in 2021, we think that Mapi's share price will reverse to the level of 20 times of its EPS. Our analysis also shows that the target EV/EBITDA multiple will also reverse to its 3 years mean to 6.1 times. If we compare it with its regional competitors, Mapi still trades at a discount in terms of PE and EV/EBITDA with regional competitors. But when we take a look at its Indonesian peers, Mapi is relatively more expensive, but we believe this is well justified. Looking at the better recovery trajectory for Mapi stem from their customer segment that are more resilient compared to its peer. Then again, we are sure that there will be a risk that can alter our conviction. So what are those risks, Aro?
Well, we've identified 4 main risks for Mapi and analyzed their implications to our 3 scenarios, which are economic downturn due to COVID-19, delayed vaccine distribution, strict social distancing measure, and delayed demand recovery. This risk will affect Mapi in the way that consumers' purchasing power and their willingness to go shopping through health concerns, which will further irritate Mapi's sales figure.
As you can see on the slide, there are worst, normal, and best case scenarios, with different derived profits in each scenario. We came up with prices of 1,110 rupiah per share for the best case, 900 for normal, and 530 for worst case. Lastly, we conducted a scenario analysis with Monte Carlo method and found a 71% buy recommendation, 19% hold, and 11% sell.
So, with bright recovery outlook led by mass vaccination, Mapi's strong target market foothold coupled with strong brand equity and online sales performance, we put forth a buy recommendation for Mapi with a target price of 900 per share, implying a 19.2% upside potential from 13 November 2020. Thank you, judges, for your attention. We are now open for questions.
Thank you, Timbangan, for finishing the presentation in time.
That will be the end for Timbangan presentation. Now, let us begin the Q&A session, which is limited to 10 minutes, and it is open for panelists only. Delegates are allowed to discuss before answering the questions. Panelists, you may start asking the delegates.
Thank you, Timbangan. This is Ari from Macquarie. Just a question on a top line forecast, right? Just want to get a sense of like, how do you see the segments playing out in terms of looking at the top line recovery in 2021? It seems like you're assuming that the 21 revenue will be 95% already of the pre-COVID level 2019. And then secondly, how's kind of the online mix as a percent of revenue is basically playing out there in your forecast? And then third, just more color on the earnings, right? Because when I see the front page of the report, there's no like kind of earnings forecast being displayed here. Thank you.
Okay, thank you so much, sir. Can we discuss beforehand?
Definitely, thanks.
Okay, sir. For your first question for the segmental revenue, we believe that the retail or the specialty stores, especially those in the active segments, will be contributing a lot to MAPI's revenue going forward. Especially, we know that MAPA is now the growth driver of MAPI in today's era. But with COVID coming along, we believe that the sports and health consciousness has increased during the COVID. So we see that the specialty stores or retail segments will contribute a lot to MAPI's in 2020, especially. But in terms of we also expect the offline and online sales channel to continue increase and continue to contribute to MAPI's revenue, since we believe that during this pandemic there will be a structural shift in the digital consumer behavior of Indonesian people, as we all see from the presentation before. Now online sales channel has contributed to 8 to 12% of MAPI's revenue. And going forward, we believe that relating to the second question, we believe that online sales will continue to contribute more to MAPI's revenue. And I think for the third question relating to the earnings, relating to the earnings, we believe that in terms of earnings, in terms of EBITDA itself, we believe that MAPI will recover to 2 trillion rupiah. EBITDA will recover to 2 trillion rupiah in 2021, implying a 52% growth year on year, and we expect it to continue to grow by a 40% CAGR from 2020 to 2024. Hope that answers your question, sir. Thank you so much.
Yeah, just to clarify, right? But on a net profit level, not the EBITDA line.
Oh, okay, sir. So in terms of net profit, can you go to yes. So in terms of as we can see here, in terms of net income, we believe that in 2020, MAPI will experience around a 300 billion rupiah loss, but I think they can recover to around 800 billion rupiah in 2021 and continue going forward. This will be this will generate Okay, so going forward, we believe that it can generate a 10.8% CAGR from 2021 to 2024.
Got it. And just to clarify, right, based on your on-the-ground checks, do you think that the spike on these activewear or MAPA could offset the weakness on the department stores and fashion? Thank you.
Sir, can we discuss for a minute?
Sure.
So when we are on the ground check, the traffic on the malls was very good, even during the pandemic, right? So the current trend is that people are currently active in sports, right? So I think we think that this trend could offset the revenue the managed revenue in the department stores. So yeah, maybe Alf could add.
Okay, I will add the explanation of my teammate Hanif. Since people are concerned more about health since the pandemic start, we believe that the active segment can outperform the department stores because we can see. Can you refer back to the online sales to online sales? If you can see from the chart on the right side, we know that people tend to the pandemic leads people to live a healthy life, and since with knowing that, we know that with its most diversified portfolio, MAPI can utilize in that trend. Thank you.
Okay, thank you. I'll leave the other panelists to follow up. Thanks.
Thank you.
Hey, Timbangan, nice team name. Just wondering if you have Timbang or consider updating the. You have a slide on I think Google mobility data on retail activities. Wondering if you have considered updating that, and how will the recent, I believe, drop affect your forecast for 2021, since most of your thesis is based on a imminent recovery?
Okay, thank you so much, sir, for the question. So actually, this we didn't update this data because we wanna follow the guideline of staying our own data to our valuation date, which is in November. But I think in terms of the data right now, we can see that it is currently dropping quite a bit. But we believe that still going forward, we just recently pay a visit to one of the malls we visited last November, just this week, and we still find that the traffic is pretty much good, and we still believe that going forward with a robust plan and vaccination that has exceeded the government's target, we can slowly regain our momentum, and foot traffic will surely come back.
And if I may add, in this graph, there is many small drops which are temporary, but the current trend is uptrend, right? So coupled with the vaccine timeline, which is currently slightly ahead of target, we think that in the future it will keep going upwards, the trend of the traffic in recreational spots, if that answers the question.
Yeah, it does. How would that affect your 2021 profits? I mean, in 2020, we saw them making losses, as you pointed out on your financials. How do you think they can make up to your profit? It seems, I think you have about 700 billion rupiah, when I saw one of your slides.
Okay. So in terms of profit, I think that in this case, we still believe that the revenue that will lead to the profit itself, we forecast that it will be a backloaded focus, meaning that maybe we believe that the revenue will pick up maybe in the Q3 and Q4 of 2021. Even though even though the current foot traffic is currently at a low pace, but we think that it will be backloaded and will translate into a profit in the Q3 and Q4 of 2021. And we believe that the online sales itself, we have seen that it has already contributed a sizable figure to MAPI's total revenue. So we believe that it would be the two main drivers of MAPI's profit in 2021, I think. Thank you, sir.
Got it. You said second half backloaded. So I'm assuming first half will still be, I don't know, possibly loss making. And if we take 2019, one half is about, I don't know, 933 divided by 2. I mean, rough. So about 450, 500. So how do we get to a 700 billion rupiah? I mean, do you see downside to that?
Sorry, sir. Could you please repeat the question?
Sure. You mentioned a second half backloaded recovery. And if we just take one half from 2019 profits to be about 450, 470, do you think there are downsides to your 2021 net income forecast?
Downside. So we think yes. We think it is possible. We think it is quite possible for us to reach the number because maybe in terms of the first half of the 2021 itself, we think that the revenue itself will be projected from the online sales channel that MAPI has. But we think that the downside risk that may affect our conviction for the second half of 2021 is in itself is the delayed vaccine distribution that would lead to delayed demand recovery. But we think that right now we have seen that the government has actually already prepared a robust plan in distributing vaccine and is right now is already quite ahead of target. So we are quite positive on the outlook itself. So we believe that it is possible for MAPI to reach that number.
Got it. I'll reserve my question if the others want to ask.
Thank you, sir.
Hi, this is Ricardo from Indica. I would like to ask you from the growth this year and next, what kind of presentations coming from the same-store sales growth and what from the additional outlets? And secondly, in light with the COVID, is there any changes from the management in terms of long-term strategy?
Okay, thank you very much, sir, for the question. So right now, to be honest, we don't quite have the breakdown of same-store sales growth and the additional stores, but we believe seeing it in the current trend for the current year, we believe that the trend itself will be heavily skewed maybe towards the same-store sales growth and the online channel, because as per MAPI's management guidance, we believe that they're currently postponing any capex increments. So we believe that they would not add any. They would not add any quite more stores this year. So we believe that it would mainly come from the online stores and the current stores that MAPI owns right now. And in terms of the long-term future growth strategy for MAPI, we believe that they will be continuing their focus on retail and specialty stores. Especially, we have seen that MAPI has started to acquire a few quite household name makeup brands such as Suwasu, Laneige, and we have seen that they are continuing their increase in online channel penetration, meaning that they start to sell their products through MAPI Mall. They increase their investment on MAPI Mall, and they start to partner with Shopee, Tokopedia, and other e-commerce brands. And we forecast that going forward, department stores itself will continue to decelerate as to MAPI's total revenue contribution, because As per management guidance, we believe that the management believes that department store is not an attractive segment anymore for them. So they are going forward. They will be still focusing on the retail segments. Thank you, sir, for your question. Hope that answers.
Just follow-up questions from Andres about this year performance. Considering that Lebaran actually coming will be in the second quarter, and that will contribute mostly for earnings for the whole years, how do you take into account into your full year earnings estimate, given that with the current vaccinate rate, I don't think there will be any significant improvement for traffic in the next 3-4 months.
Okay, thank you so much, sir. Maybe we discuss beforehand.
So Lebaran will be on May, right? And we see that the vaccine timeline, this one, the vaccine timeline will start to commence for the general public in April. So we expect that there will be a pent-up demand as people will be more brave enough to go out from their home and go shopping, especially the upper middle who has more money than who is less independent financially than the lower middle. And Alif may add some few notes.
Yes, I think that as what Hanif said, we believe that seeing the market's current target market, which is the upper middle class, we believe that they are greatly cushioned by the excess liquidity that they have, as we see that they are currently saves a lot of money in their banks, and we think that we believe that that excess liquidity can lead to a better earnings figures this year, even though the Lebaran will come in May. And we believe that this would be better to Mapi because if we compare it to Mapi's competitors being Ramayana and Matahari, we believe that Mapi is less cyclical than the of its competitors. Hope that answers your question, sir. Thank you.
Okay, thank you.
Are there any other questions from the panelists?
Maybe just last question for me. What are your thoughts with regards to the changing consumer habits towards online purchases? And just trying to see if any three of you has purchased from Mapi versus from the online shops recently.
Sorry, sir, can you repeat the last part of your question?
Yeah, no, I'm just wondering if between the three of you, if you have bought more from Mapi versus the online stores in terms of fashion stores last couple of months.
Okay, thank you for your question. Maybe to start answering your first question in terms of the digital consumer behavior itself. We think from the retail industry perspective itself, it can be both a blessing or a curse, because we think that in terms of those who doesn't have any strong foothold in their own channel, we believe that they would be severely impacted because right now the trend is shifting towards online, but we believe that the trend itself is a blessing towards Mapi because first, Mapi has already invested a lot in their digital sales channel, And we have also seen that their online channel has already started to contribute to their total revenue, and we believe that it will be a positive thing going forward. And second one, if we look at it, if we are concerned about the competition from other e-commerce, we believe that it would not be too much of an effect for Mapi, because first, Mapi has its exclusive brands distributed exclusively from Mapimo, and second, Mapi has even started a partnership with the other e-commerce players such as Shopee and Tokopedia. This going forward, meaning that Mapi does not only sell their online products through their own e-commerce brand, but they also sell through Shopee and Tokopedia, such as their brands such as Sulwasu and Laneige and etc. Maybe Aro want to add. Adding what Alif has said, Mapi has invested a lot in its brand loyalty program, such as the discount for their products, and I think this will eventually bring its brand loyalty towards Mapi, since Mapi has a lot of top of mind brands in their pocket. So coupled with what Alif has said, I think the outlook for the online sales and for the omni channel for Mapi, it will be good. Maybe Hanif will.
Yeah, and Mapi currently has the exclusive stores for Zara and Digimap and others. And those brands that is exclusively sold by Mapi isn't sold in any other competitor. They are exclusively sold only at Zara.co.id. And people couldn't sell Zara in Shopee and Tokopedia, because if they sell Zara in Shopee and Tokopedia, the price points will be higher than Zara on the original website. So the consumer will prefer to buy from other e-commerces, and they would prefer to buy from Mapi itself.
So in terms of the second questions referring to us personally, I think, to speak on my behalf of myself, I think yes, I have purchased several items, several sporting items specifically from Mapis during this pandemic. I think this pandemic has gotten us more aware towards sports and health. That's what we believe that will contribute to a positive outlook for us to Mapi.
Got it. Thank you. If you do visit the mall, please stay safe and wear masks. But thank you for that.
Thank you, sir.
Thank you.
Due to the limited time that we have, this is all for the Q&A session. Thank you very much, Timbangan and panelists. I would also like to remind Timbangan to ensure that your microphone is muted and your camera remains on.
It is time to hear some feedback from our panelists for all the delegates. Panelists, you may start your feedback from now. I would like to ask for the panelists, if you have any feedback for all the delegates, please state your feedback right now.
Hey, hi. Sorry, I'll go ahead. I thought you were meaning for us in the online feedback. But for me, I mean, hey, sorry, I'm hearing a lot of feedback. Oh, I'm hearing a lot of audio feedback. Sorry. Hello, hi, can you hear me? Yeah. Yeah, Ricardo, why don't you go ahead? I think I'm having problems with the audio.
Can you guys hear me okay? Hello, this is Ari.
Yeah, we can hear you, sir.
Yes, we can hear you.
Okay, great. So sorry, I'm turning off my video just in case that is consuming the bandwidth. So I think, yeah, overall, pleased with the overall presentation from everyone. So well done. So in terms of the presentation format and the teamwork, I think everyone has done a really good job with those. So really much appreciated in terms of the efforts and also the energy that basically come into the presentations. I think a couple of suggestions in terms of improvements. I think in terms of slides and presentation, it would be good to have the thesis up front. Some of the presentations are basically looks nice in terms of the having the company description and then also the industry walkthrough, but then kind of missing that summary thesis slide on the front. So I think if that's can be included earlier, it'll be better. I think for the audience and also for the panelists to basically digest the thesis quicker. And then I think secondly, I think in terms of the consistent evaluation methodology, I think will be good. So I think some of the teams they shown pretty consistent evaluations, but some not. So I think it will be basically be very positive to basically have the consistent methodologies in terms of when calculating the implied multiples and then the valuations used. Either that's sticking to the EBITDA, also PE or DCF. And I think the third feedback is that some teams have done a nice job in terms of like focusing more on the forecast and then kind of guiding the valuation and what we can expect in terms of the stock, where the stock should be going. And then some teams basically focusing putting a lot of weight in historicals, which I think is still important. But then again, in the capital markets, basically when we talk with the buy side, they focus a lot more in terms of what will happen in the future. And then the fourth feedback is that I think some of the teams have solid presentation in the front, but then I think some are basically, some good slides actually hidden in appendix. So that relates to the forecast in particular. So I would encourage basically putting those forecasts up front in the presentation earlier instead of having in the back. So I think that will basically add to the clarity of the thesis and the call. But overall, well done everyone for basically a lot of hard work. I assume that you guys have put in and going through the final round. It's going to be very tough for us to pick the winners. But well done. Thank you.
Hey, hi, participants. Thank you very much for the presentation. I myself am, to echo just what Ari said, quite pleasantly surprised by the general quality. And I myself joined a similar competition, I think 14 years ago, and I got third place, I think. But a couple of feedbacks from me. I think number one is there is a general need to be overly critical. By the way, I'm not turning on my video because of streaming issues. But yeah, number one feedback is that there's a need to be very overly critical on the outside and downside risk to where the company can go. While we make a thesis and it's a competition, right? So we make a one direction call, right? But heavy in investors' mind are typically what are the risks that can cause the thesis to be wrong, and hence how do you position as an investor? How do you position yourself in light of that risk? So I'm seeing a couple of broad risks discussed, but I feel that we can go deeper into it. That's the number one feedback. Number two feedback is that I've noticed in the reports there are a couple of factual mistakes. Some of it in reference to what is being reported on the news. But bear in mind that I think in our news source nowadays, there's just focus on quantity, but less focus on quality. So do double check your sources. I will not cite by team names, but if any of you individually approach me, I would be happy to share which are the factual errors. I guess the third feedback is that some has prepared really well on the potential question and answers, and I think some can do a better job. There are a couple of basic questions that was asked, and the hope is that you can explore that questions deeper. So yeah, those are for me.
Thank you, panelists, for your feedback.
Due to some technical issues, Mr. Ricardo will give his feedback after the next session, which is the certification handover session.
Now, please welcome our esteemed Managing Executive, Mr. Michael Abraham, as the President of the 20th ICMSS, to hand over our token of appreciation for distinguished panelists.
Okay, as the grand final of the 20th ICMSS is finally finished, I would like to represent the 20th ICMSS committee in expressing our deepest gratitude to all the panelists for participating and providing us with insurmountable insights in the 20th ICMSS Equity Research Conference. So I would like to give a virtual token of appreciation to all of our panelists today. So our first certificate is presented to Mr. Ari Yahya. Thank you so much, Mr. Ari, for participating. The second token of appreciation is dedicated to Mr. Andre Nasseri. Thank you so much, Mr. Andre. And last but not least is presented to Mr. Ricardo Silan. Once again, thank you so much to the three panelists that have made time to come here and to provide a productive session to all the delegates. The 20th ICMSS is deeply in gratitude to all of you. Thank you so much.
Thank you, Mr. Michael Abraham Mukom, for presenting our token of appreciation. This marks the end of our grand final presentation of Equity Research Conference, the 20th ICMSS. We would like to thank the panelists for attending the grand final presentation and spare their time. We wish you success in all of your future endeavors.
We would also like to thank all the delegates for preparing the presentation neatly. We hope this session gave you valuable insights from investment experts to hone your company valuation skills. We wish you good luck for the upcoming Best Equity Research Team announcement.
Now we are going to enter lunch break. After the lunch break, we will have a capital market sharing session, so please be back in the room by 12:30 and no later. Thank you, and see you in the next session.